against his stock in the company, which could lead to margin calls if the stock keeps falling like this. We should not be giving investment advice to a billionaire, but one of the options he has that he can buy back the shares, he can go private. Remember, he still owns 84% of the company, and the stock has crashed by 60%.
It's probably worth doing a little bit of hedgy history here. Bill Ackman was tweeting quite a bit. Excited by this whole event? Why, Nishan? What is it about these two?
Well, indeed, there is no dearth of friendship between the two famed activist investors. Let me remind our viewers here that Ackman famously fought with Icahn a decade ago over Herbalife and ended up losing a fortune. Now he keeps roasting Icahn on social media. He has even said that the company reminded him of Archegos, the family office of Bill Hong, which was blown away, collapsed 2021 because of his leveraged bets.
Yeah, amusing to see that play out on Twitter. Nishan, there's a little bit of irony here, because here you have a famed activist investor who usually goes into companies and tries to change something, and we have that type of targeting investor becoming a target himself. Has that happened before? How rare is this kind of thing?
I mean, so there are not too many activist investors listed, but we have seen increasingly Third Point, Bill Ackman's own firm has a listed vehicle as well. So this is not for the first time. Again, let me remind our viewers that in 2021, one of the biggest shareholders in a London-listed fund managed by Dan Loeb, Third Point, launched a public campaign demanding changes there. And just last year, a London-listed money pool linked to activist firm Trine said that it will return clients' capital and close after months of wrangling with their investors on how the fund is run. So it's not the first time at all.
When it comes to the Hindenburg accusations, what are they actually, Nishan? We've got about a minute here.
Yeah, I mean, it's a list of acquisitions, but Anderson, who recently very famously took on India's Adani Group, has accused the company of costly missteps, lousy performance, and above all, dramatically high overvaluations. So basically, he's saying that the company is traded at a higher price than the value of the underlying assets, which is not normal in this year. Normally, closed-end listed funds trade at a discount because you can't exit them quickly.
Okay.
Of course, Icahn has called this allegation self-serving and vowed to fight back.
Yes, absolutely. Hey, Nishant, thank you so much for that. That is Bloomberg's Nishant Kumar. Bloomberg Surveillance Early Edition. It continues in the next hour. Kriti Gupta is in New York. Tom McKenzie here in London. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like, just the joy that you had brought to the city was phenomenal.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Hurdling ahead, Republican and White House negotiators are making progress towards a debt ceiling deal, which is said to include capping federal spending for 2 years. Tech shares remain in focus amid the frenzy for AI stocks, but investor Cathie Wood is missing out. Her flagship ARK fund dumped its stake in Nvidia right before the chipmaker's blistering $560 billion surge this year. And Ford strikes deal with Tesla in a rare partnership among rivals, giving its customers access to the largest, fastest and most reliable network of EV chargers. Welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie, stepping in, of course, for Anna Edwards temporarily here in London with Kriti Gupta in New York. Kriti, there's a little bit of optimism across European equities this morning, but once again, investors here held hostage by the news coming out of DC.
Absolutely, and that becomes kind of where the focus starts to shift a little bit on some of the fundamental stories. And note, I said just a little bit. You are seeing futures virtually unchanged here. Tom, essentially this idea that as Washington puts you in a stalemate, do you buy in to the hype that you are seeing in the tech space? Not just the AI-driven rally in NVIDIA and some of its peers. We're going to dive into that in the rest of the show, but some fundamental stories as well. The Tesla story that you just talked about, the idea that the world is changing, tech is becoming a bigger part of our lives, but is that enough to really incentivize stock market investors? At least in this morning's trade, it doesn't quite look like it. Futures really set unchanged, 41.56 on those contracts. The 2-year yield, though, continues to surprise to the upside, 4.50, almost 4.50 on the front end of the curve, getting very scarily close to the 5%. I love to round up, kind of like when you're young, you round up to the age that you really want to be at. 2-year yield at 4.49, coming down a little bit in this session. So really watch the technicals here because, again, as you say, Tom, the debt ceiling debate is really what's going to be driving the bond market, at least as we get closer and closer to the X8. The last Friday before we head off into the long weekend stateside, and Congress apparently does not work the long weekend. So something to keep an eye on. The Bloomberg Dollar Index down about 0.2% following the yields picture, but inverse, you get the commodity picture a little bit higher. That kind of dollar weakness perhaps giving a little bit of a tailwind to NYMEX crude trading, Tom, with a 72 handle.
Yeah, it's interesting. Commodities, we're seeing a big tick up in terms of iron ore prices and copper prices, so reversing a bit of a trend that we've seen this week, and that's lifting the sector, basic resources across Europe this week, or at least in the session today, I should say. and the FTSE 100 benefiting to some extent from that. You're flat, though, now across the FTSE 100. Across the European benchmark, very, very modest gains. Again, part of it is down to investors waiting to see what happens in terms of that debt ceiling debate. And, of course, in the UK, the focus is on what's happening with yields because they continue to run up. And the focus as markets start to price in maybe 5.5% in terms of the Bank of England, with the Fed, of course, in focus as well, repricing and the PCE deflator indicator out later today. Across some of the individual names, we can change on the board then and see how things are shaping up. There's a couple of individual corporate stories that are of interest in terms of what's playing out here. Rio Tinto, again, talking about the basic resources story. Rio Tinto being revised higher by analysts in terms of their price targets for this stock. Morgan Stanley pushing up their rating on the company because they say that its copper holdings are underappreciated. And that ties into that EV story that we were talking about. Tesla, Ford, EVs, of course, copper central to that. And Morgan Stanley saying that's underappreciated as a stock and it's rallying today in the session. A very different story, though, for Casino, which is a major owner of supermarkets in France. If you ever visited that country, it may have been a place you popped in for a box of croissants and some foie gras. It's currently down about 8.4% because they're in negotiations with some of their creditors. The stock was suspended on Monday, retrading again today, and pressure on that stock as they look to sell off some of those supermarkets. Again, across the benchmark, modest gains of 0.2% here in Europe. Pretty.
And of course, to your point, Tom, even as we watch those micro stories, the macro still surrounding the Washington debate around the debt ceiling. Republican and White House negotiators are moving closer to an agreement to raise the debt limit as they try to avert a U.S. default. Nobel Prize-winning economist Paul Krugman spoke about his concerns yesterday.
What's happening right now is that in the effort to hold down headline spending right now, we're actually kind of disinvesting in the country's future, and that's pretty alarming.
Joining us now is Bloomberg economy and government editor Jill Deese. Jill, it looks like we're getting closer to a deal. It's starting to see some of the cracks kind of getting closed, but what kind of progress have we made? Are we going to make the X date?
Well, Kriti, it seems like we might actually make it. I think that what we're seeing is potentially a deal that's put together by the Republican negotiators and the White House negotiators as early as today, Friday, in Washington. Now, while they haven't agreed on the amount that they'd be putting under this cap, it does seem like they're moving toward agreeing to plan to raise the debt limit and cap federal spending for 2 years. There's some provisions that are still being discussed in terms of energy grids. We've got some fossil fuels discussion in there. So all of the details behind that, including, as I said, the amount still has to be worked out. But ultimately, it does seem like there could be something that goes to Congress as soon as Tuesday. And then that would set us up, if that is able to get through, for something that puts us in deal. It gives us a deal before we actually reach that X date. There's some provisions.
I wonder, Jill, if not in the US then elsewhere, whether the spending caps that are going to come through as a result of these negotiations are being overlooked, at least underpriced by markets.
Yeah, Tom, so I think that ultimately we need to see what the details actually are for these spending caps. And I think that that's probably what markets are looking for, right, is those more details. I mean, we're sort of in this weird flux zone right now where while it's somewhat optimistic that we do have some progress here, at least compared to where we were earlier this week. We at least have an idea of how long the spending cap may be. Remember, again, Republicans were originally looking for something as long as 10 years. We still don't know that total amount yet. We still have to see how all of this breakdown looks like. So hopefully we'll have something that gives us a little bit more insight into that by the end of Friday. And then maybe that's something that investors can actually look at as they're trying to price in how exactly this could have bigger impacts on the economy going forward.
Jill Deese is covering all things of the debt ceiling for us. We thank you, as always, of course, watching that very, very closely. But at the same time, we're watching the consumer, the underlying U.S. economy, with warning signs already flashing on the health of that spender. Quarterly earnings from big box and budget retailers this week gave us insight into the depth and duration of the economic slowdown. Just a couple of names, Costco and Gap, rounding out the earnings season at yesterday's close. Joining us now to walk us through it, Bloomberg's Simone Foxman. Simone, a mixed picture from Gap and from Costco.
Yeah, Costco came in pretty weak, but a lot of the drag on the earnings per share, about 50 cents drag, was based on its ending its container shipping business. So that, I think investors reacted to that, and then they looked through the earnings and were a little bit more optimistic. But overall, Costco reiterating some of what we heard from the other big box retailers. People are spending less when they are coming into stores, and Costco specifically focuses on a pretty high-end segment. So that was sort of an interesting data point. Also an interesting data point out from Gap. Shares did pretty well after the company beat a lot of estimates, but there was a very low bar among analysts. This is a company going through a turnaround story, and we've seen a really mixed bag in apparel over the past couple of days. Again, companies beating really low bars that executives set, but also this idea that there's not a recession yet, so people still are spending on some of this stuff.
And Simone, what are we hearing from executives, from leaders of these businesses? How much concern have they been expressing?
Well, there's definitely the sense that consumers are softening, but they may not be cracking yet. There are still things they want to spend on, and a lot of those things are related to what they've experienced over the last couple of years. They've had to stay home over the course of the pandemic, and now they're continuing to spend on things like beauty, like apparel when they go out, but not necessarily on things like home improvement. There's a little bit more strength when we look abroad, but this is specifically on the U.S. consumer. And so they're pulling back on things like groceries, where they're turning to sort of the private label items. They are delaying some of their long-term home improvement projects. You know, one of the other things we've heard from a lot of executives has been about shrink and read theft in this. This seems to be an ongoing problem for a lot of, an increasing problem for a lot of these retailers. Again, the economy looking a little bit worse for the consumer, but we're not yet hitting this wall. We're not yet hitting this recession.
Simone Foxman, all about the consumer story. As we're getting mixed signals, we're going to keep her posted on those developments. Meanwhile, across the Atlantic, Turkey's central bank has extended its interest rate pause for a third month as it tries to keep the lira stable. This policy decision comes just ahead of the country's presidential runoff this weekend. Bloomberg's Yusuf Gamal Eldin standing by, joining us now. Yusuf, walk us through why this is important.
Well, this is not just about a repo rate that stays at 8.5% as expected. This is about a central bank that doesn't want to appear like it's taking sides. It's about inflation at 44%. And that kind of raises the stakes for the runoff on Sunday. Remember, in the first round of the presidential election, we had the incumbent President Recep Tayyip Erdogan. He got 49.5% of the vote. You had his most credible threat, Kemal Kılıçdaroğlu. He came in second. And then third was Sinan Oğan, who has now endorsed the incumbent president. Erdogan, who's, made quite a bit of a name for himself in terms of high borrowing costs that he's pushed down. He's ruled out rate hikes for the future. And that's the bigger issue, is what happens in the post-election world. And regardless of how this pans out, they're going to have to return to a relatively sustainable path of orthodox monetary policy, guys.
Yeah, wow, 40%, plus 40% inflation. I thought it was bad here in the UK. Talk to us about, is tourism a bright spot for Turkey? Is a weak lira proving attractive for tourists?
I mean, Tom, I was there, 10 days ago, and it was as busy as ever. They have this brand new airport. They do about 55 million passengers a year, and the latest numbers underscore the resilience of tourism in Turkey. I mean, we are up 29% on the year. That is in the month of April. You are up 12.3% in the month of March. As much as foreign currency inflows are still very much there, because the central bank has been intervening on a regular basis to try and prop up the Turkish lira. They have a net negative international position, which hasn't happened in 21 years. It gives all economists out there a lot to work with in terms of case studies and analyses, guys.
Yeah, indeed, probably for years to come. Yusuf Gamal Eldin, thank you very much indeed for the preview, of course, and that runoff this weekend. Coming up, Christian Kopf, head of fixed income and FX at Union Investment, joins us. We'll get some calls there on how to position within these fixed income markets. And later, we're going to speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. Is the rally in tech overdone at this point? Plus, Tesla and Ford forming a rare partnership for their EV customers. More details on that still ahead. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest for the. If they invest for the right reasons, just keep at it. They're all very additive. And if you keep at it.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Some very unique characteristics.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Look, it's all about the debt ceiling debate, and you're already seeing it getting very clearly priced into the markets. But what's the trade here? Do you hop into the bond market at a time when the full faith and credit of the United States is at risk? And in some ways, yes. And here's why. One of the reasonings, or one of the cases to do that, it comes down to the real yield, because you're starting to see U.S. real yields actually rise. That was one of the big issues that essentially with kind of onset of inflation, yields weren't giving. And that's really where you start to see that reverse. You're seeing 248 on the 2-year TIPS yield, the highest, going all the way back to the global financial crisis. That is a big deal when it comes to whether or not you want to hop into the bear. Is that a fair trade to make? Let's say we do actually get closer and closer to this exit. In these next few days, what's the attractive trade? One of the big issues that essentially with
yes, Preeti, I think that this is a pivotal time we have right now. We've got, the debt ceiling discussion, which likely will come to some form of a conclusion today or at the latest over the weekend. And then we have inflation numbers coming up and the decision whether the Fed will do one more hike or another one or two more hikes. Now, when we look at what you mentioned here in the U.S. bond market, we see two things. At one hand, we see upward pressure here on the nominal yields, which come from a decline in risk aversion as the market is pricing out the risk of a sovereign default in the U.S. At the same time, we've got these relatively elevated real yields. On the 2-year sector, we've got a 2.4%. In the 10-year sector, we've got around 1.5, 1.6% real yields. These levels are already quite attractive. And I think very soon we will see a situation where people will start to receive those yields.
Christian, so that's the short-term play. Let's talk about the long-term play. The latest developments out of Washington essentially suggests a federal spending cap of about 2 years. That's good news when you're getting closer to those debt ceiling agreements. But Christian, in terms of growth, when you're seeing a lack of government spending directly affect GDP, are you at all concerned about the fact that that lack of catalyst from the U.S. government is going to hurt America's GDP? How do you view that?
Frankly, I'm not that concerned. I think that the spending caps, the caps on non-defense spending that will likely come out as an agreement today, should not have a material impact on economic activity in the United States. There will be ways to circumvent those spending caps, and I don't think that the magnitudes we're talking about here should have a material impact on output. So I don't think that this is a reason to be concerned about economic activity in the U.S. We are in a situation where the first quarter GDP growth was much stronger than expected, and overall employment growth is still relatively robust in the U.S. So if anything, it's probably a good time to take back some of that fiscal stimulus in the U.S. So I don't think that's a reason really to go along here the bond market. I think the reason to go along the bond market is the fact that we already have relatively high real yields, especially compared to other regions in the world. I mean, the numbers that you've shown here on the 2-year real yield in the US, and then you've got the 10-year real yield at around 1.6%, they compare quite favorably to other regions of the world. In Europe, the real yield on the 10-year sector is close to zero.
Hey, Christian, there's a scenario by the end of the next week, we have a deal on the debt ceiling. We get the PC deflator out later today. The expectations are it's going to actually tick up from the previous month. We saw those jobless claims being revised lower yesterday, a reminder of the strength of the labour market, at least relative in the US. There's a scenario by the end of next week where June is going to be looking like it's locked in for the Fed. I mean, would it be hyperbole to start, questioning whether or not this Fed may even be looking at 6% by the end of this year?
Well, you're coming back to the 6 is the new 5 discussion, no? That was a discussion we had in February this year. There was the US Monetary Policy Forum in February in New York, and at the time, 6 is the new 5 was making the rounds. Now, I don't actually think we're going back to 6% or discussion, the 6% overnight rate here in the US. I could see a scenario where the Fed will hike in June. That is our long-held call. Some will depend on the inflation numbers we will get on the 13th of June. But overall, with the specter of sovereign default dissipating, relatively strong economic activity numbers, stubbornly high inflation, relatively strong labor market, our call is still that the Fed will continue to make at least one more hike in June. But I don't see the Fed going to 6% here, no. I mean, for that, the conditions are not in place. And keep in mind, we do have disinflation in the US now. It is actually stronger and faster, the disinflation, than in Europe. So I think that one more hike, should probably do it for the Fed. And then they will start to wait for those disinflationary forces to play out.
Well, there you go. You point to the divergence between the US picture versus Europe. I know you've got your ear to the ground when it comes to policymakers at the ECB. 375 is where the benchmark is now for the European Central Bank. We had a reminder, though, of the weakness coming through from Germany and that economy earlier this week when it fell into recession, of course, for the first quarter. How far can the ECB push it, given the fragility that we're seeing in economies like Germany now?
Well, first of all, the shallow winter recession we have had in Germany, 2 quarters of negative GDP growth, were related to the very high energy costs. And we can now observe a fast decline in energy prices. I mean, we've got the TTF contract for the natural gas in Rotterdam trading below 30 euros on the megawatt hour. So we see a rapid decline in energy prices, and that is very helpful for the companies and also for the consumers. So that should help economic output, also actually helps the current account position of Europe. Second, we have relatively robust growth still in other countries of the euro area, especially in Italy, but also Spain. So Germany is not the only country out here. Third point has to do with interest rates. I mean, I think that it's fair to say that we already have a contractionary monetary policy in the US, a very tight monetary policy with an ex-ante real interest rate of around 1.5% to 2.5%, depending on the tenor that you choose. We don't have that in Europe. Our ex-ante real interest rate on the inflation-linked bonds is 0. So I think there the ECB still has a ways to go. And then also I think that the wage dynamics in Europe, there is still a lot of catch-up growth to be done here in wages. People have seen a decline in their real income over the last year because of the very high levels of inflation. And we see wage settlements slowly creeping higher in the euro area. So there is a case to be made that the ECB should continue to hike, and that's actually what we believe.
Christian, in that scenario then, talk to us about how the interest rate differentials kind of come perhaps in conflict with some of the positioning around the debt ceiling that you're seeing in the dollar.
That is a very good point, Kriti. So we actually do have that conflict. I think right now, if the debt ceiling problem gets resolved, we could see euro-dollar move to 105 because, the risk aversion is being priced out of the market. But actually, our call is still for euro-dollar to move higher by the end of this year, and that is driven by those differences, the divergence in the monetary policy. We do expect much more rate hikes, if you wish, from the ECB than them from the Fed in the second or in the summer this year. So that should, over time, help to drive the euro higher. Now, there's a debate about how much the ECB will do. I'm just here in Dubrovnik, Croatia, attending the national conference, the annual conference with the National Bank of Croatia. We just had a presentation here by Philip Lane. The slides from his presentation are available on the ECB website. And he's pointing out to a lot of disinflationary forces which are at play in the euro area. But there are other people here in the room, people from the BIS, people from other central banks, who argue that actually inflation could be much stickier, and that we may be moving away from that low inflation regime that we've had in Europe for 20 years or so, and that is a cause of concern for many central bankers in the European Central Bank Governing Council. So I think that there is a debate really on how sticky inflation is and whether it will come down in the way that the ECB is forecasting.
Christian Koff over at Union Investment, making time for us in this very busy day. We thank you, as always, for your time and for your insight. We want to keep you up to date with news from around the world. Here's the first word. Bloomberg has learned that UBS and the Swiss government haven't agreed to the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules. Siemens Energy says it's experiencing a surge in demand for green transition technologies as governments around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, CFO Maria Ferraro says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
Alibaba says it plans to hire 15,000 people this year, pushing back on reports that the firm is laying off employees. The Chinese e-commerce giant described reports of layoffs as, quote, rumors, and said employee departures are part of the normal flow of the business. Tom, your take on this Alibaba story at a time when it feels like a lot of the world is dealing with an extremely tight labor market.
Yeah, indeed. And of course, this is a sector that's been under pressure as a result of the regulatory squeeze, and officials have come out and said, do you know what, we're going to support the tech sector now. But there's a political angle to this as well, which is that companies like Alibaba, they don't want to be seen to be laying off huge numbers of workers. It doesn't play well with, of course, their patrons, particularly at the state level or the provincial level. So there's that part of it as well. But the interesting story at the corporate level is they're looking to spin off about 6 of their divisions, the logistics part, but also the cloud division as well. So major restructuring underway overall for Alibaba.
And how does that square then with some of the, perhaps the regulatory kind of deal when it comes to Alibaba? When I think Alibaba, I immediately think all the controversy around Jack Ma. Where are we on that?
Yeah, Jack Ma has kind of been revived to an extent. He's still keeping his head down, but we've seen him appear now in mainland China. So he seems to be on surer footing, and they've got the blessing, it seems, to do these spin-offs. In fact, they're being encouraged to do so because there's always been this concern amongst regulators about the oversized power and play of some of these tech companies. So they seem to get at the back of that. And again, investors, Anna, say, look, you can unlock a lot of value here. Again, on the jobs front, the context is there's about 20% unemployment amongst China's youth. So there is that as well to bear in mind. It's pretty scorching in terms of the unemployment pressures there, and they don't want to be playing into that.
Yeah, it's pretty fascinating. I love to look at the Alibaba story because even though we kind of group it in the tech story, Bradley and Tom, of course, you're an expert here in this. The idea that at some point they actually did want to build out that financial arm is fascinating. Yeah. It's kind of the American equivalent of if, say, Apple wanted to build out a bank, for example. I'm sure that's a little bit of a stretch, but that's the way I think about it.
I don't think that's a good analogy, and I think we definitely need to keep an eye on what happens with Ant Financial, whether they revive those IPO plans, of course. That is definitely one to watch. Now, coming up, we're going to speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. We'll keep an eye and a finger on the pulse on tech, get his views on this AI-fueled rally that we've seen. NVIDIA, does it have further to run? Jay Woods coming up. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government. Frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100%
back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Hurtling ahead, Republican and White House negotiators are making progress toward a debt ceiling deal, which is set to include capping federal spending for 2 years. Tech shares remain in focus amid the frenzy for AI stocks, but investor Cathie Wood is missing out. Her flagship ARK fund dumped its stake in NVIDIA right before the chipmaker's $560 billion surge this year. And I'm Kriti Gupta in New York with Tom McKenzie, stepping in for Anna Edwards in London. Tom, a lot going on the macro front, a lot going on the micro front as well, but the debt ceiling still the focus all around the world.
Yeah, and some of that temporary relief that came through in the European session has come off now. So you're flat across the European benchmark as investors kind of look for the next catalyst and wait on that deal to come through, if indeed it does materialise. Euro dollar currently gaining 0.1%. Of course, the Bloomberg Dollar Index is off in the session. A couple of individual corporates to bring to your attention. Rio Tinto, it's been upgraded by Morgan Stanley. It says that its holdings of copper are being undervalued by investors, and that stock is gaining on the back of that upgrade from Morgan Stanley, 3.5%. It ties in, of course, to the shift and the repositioning around electric vehicles. And in the supermarket space in Europe, particularly in France, Casino is embroiled now in discussions with some of its debtors. It's going to have to sell off a number of its supermarkets. That stock, after being suspended on Monday, retrading again today, taking a hit down 7.8%. Kriti.
Yeah, seeing a little bit of pain on the micro front there. Let's go back to the macro, zoom out a little bit, Tom, because stateside futures virtually unchanged. I mean, you're seeing down about 0.2%, so a little bit of sentiment souring, but this makes sense. It's a Friday. There's a long weekend coming up stateside, not to mention the X date getting closer and closer. So to see that to the downside, not that much of a surprise. Does it turn around, though, as we get developments, perhaps before the long weekend, which I'm told Congress is not working. The 2-year yield is something to keep an eye on as well, because, again, as sentiment sours, a bid into the bond market, 448 on the front end of the curve, lower by about 4 basis points, and with it taking down the dollar. And that's going to be a really interesting story as, again, we talk about simply what is driving the dollar story, given there's so much speculative positioning in the greenback, despite the debt ceiling concerns. Of course, NYMEX crude, the ripple effect of the dollar largely showing up there. That's where you're seeing a little bit of sentiment change. Still trading with the 72 handle, Tom, but a little bit stronger since what we checked in about 30 minutes ago.
OK, let's get back to what was at least a key driver for these markets yesterday, and probably will continue to be so in the weeks and months ahead, which is, of course, AI, and particularly the focus yesterday on NVIDIA. Let's bring in Jay Woods, Chief Global Strategist at Freedom Capital Markets, to talk all things markets as well. But let's start with tech, Jay. Good morning.
Hey,
Thanks for joining us. And the story that we have is very well read on the Bloomberg around ARK, of course, Cathie Fund and the main fund selling out of NVIDIA earlier this year, so not benefiting from the upside that we've seen in the last couple of days, the last few weeks. for that stock. How much of a critique is that of the ARK strategy?
Yeah, you know, I'm not here to be critical of the strategy. I mean, last year they sold out of Twitter, and that would have been the biggest winner in the fund as well. It's struggled lately. It was down 81% peak to trough, but I'm seeing some progress there. You want to look under the hood. Some of the stocks within the sector have been acting much better. You look at Exact Sciences, DraftKings. We're seeing, and Shopify, those are three that are starting to turn. And then it's been basing. You've seen the stock go sideways, up 30% year to date, and it's recaptured that 200-day moving average. It tricked us once, it did that before, but let's watch this level closely, because I think if the small caps start to turn, if AI becomes more of a story and tech follows it from there, she's got some good product in the fund, and we can see it take a nice leg higher. Is it going to be euphoric like it was the last time it ran up? No, but there is a lot to reverse here, so there's progress being made.
Jay, does this AI story have further to run? How do you want to play this? We were speaking to guests earlier on Bloomberg TV saying, look, there's a risk that you get sucked into some of the frothier, some of the boomier stuff, not looking at the industrial play around AI. Is that the way to position?
Yeah, I mean, NVIDIA had a day of all days, and that guidance was something I've never seen in my experience here. That was just phenomenal. So I think there is more room to run. The semiconductors have been strong all year. There's a lot of strength. There's semiconductor stocks breaking out of large bases, Micron being one of them. So I think this is a story that's here for a while. There is a euphoric sense to it that gets me a little concerned that we go out too far above our skis and we can see some pullbacks. But this is a story that's not going to go away anytime soon.
So, Jay, that is the defensive kind of trade, almost the beta play of it, which, by the way, we should say that one of the tailwinds is also coming from the debt ceiling story, the macro story. If you're worried about a recession around the corner, you go defensive, right? That's something we've been hearing from a lot of guests on Bloomberg Television and radio. But then there's the other side of it. If you're worried about recession, you're worried about small caps. Are you?
Yeah, I mean, small caps have been the laggard all year. And we look at the Russell 2000, and what are we seeing? We're seeing, you know, sideways action, but we're seeing higher lows. It's at a very critical level right now, testing its moving averages, testing its recent uptrend line, going back a few months. Like the market, it's kind of stuck in that position where we're going to break one way or another. If we can get a break to the upside in the Russell, and historically, this is a seasonal period where we see some strength. As we go into the Russell reconstitution, which will be later in June, we tend to see a little bit of a rally. So I'm hopeful, and hopeful is the key word, that this trend continues, and the small caps, if the regional bank crisis can abate a little bit more, can bounce back and be strong contributor in the second half of the year.
Well, it's an interesting dynamic that you're seeing in the Russell. And before we move forward, I want to tell our international audience specifically that you've been on the floor of the New York Stock Exchange for, what, 30?
31 years,
31 years. So you have seen the highs and the lows. Talk to us a little bit about the breadth here of the market. One of the big concerns is simply that this is a tech-heavy market. To me, it feels like you need both the Russell and the NASDAQ on your side for this to be sustainable.
You do, and it's one thing that we talk about that's a little concerning right now. The breadth has not been there. It's 10 stocks leading us up, but it's the right leadership. When you're looking for things to turn, you want tech to lead. Now I want to see the financials find their legs. It looks like that May 4th, May 5th washout that we saw in the regionals and some of the larger banks may be the lows. If that is the case, the Russell will slowly come back and we'll see a broadening of the breadth. That is the one thing that has me concerned. But right now, consistent higher lows with a base or a resistance level at 4,200 in the S&P 500. We may break above, and then the Russell here, the 200-day moving average. There's some constructive things happening under the surface. I'd just like to see it broaden out a little bit more.
Hey, Jay, look, we know the connection between higher yields and financials and the prospects for the banking sector. Higher yields and tech, that's not meant to go together. Is this temporary, that we've seen these yields run up, and yet NASDAQ has continued to perform well? Is this a new trend, or is this a temporary evolution?
You know, I think COVID has changed the way we look at everything. You know, I have no idea why, you know, it's not the textbook way of doing things. You know, the tech stock should be getting crushed given the rise in rates. But no, they're not. What people are doing is they're separating. It's not all tech, it's select tech. They're finding the winners, the best in brands. You're seeing it across all sectors where, you know, the leadership is doing well, but that doesn't mean the tide is lifting all boats. We're seeing, you know, very selective trading, and NVIDIA was just, you know, you look at the SMH, NVIDIA is far and above everything else in that sector, and it's starting to lift all boats. You know, if rates continue to go, if we go 6%, yeah, I think that will have a direct impact on the tech sector, and we should see, at worst, a pause. I mean, at best, a pause, and at worst, a little bit of a sell-off.
You've set me up really nicely, Jay, talking about tide lifting all boats. So cruise lines, this is in your notes to us. This could be a sector that's turning, you say?
Yeah, you know, it was a nice segue. I've been watching the charts of Carnival Cruise Line, Norwegian Cruise Line. I talked about COVID being something that disrupted everything, and we'll look back and we may have an asterisk on how we looked at the economic effects on things. Well, the cruise lines got hit, and, you know, like a cruise ship, it takes a long time for these things to turn around. And what I'm seeing are constructed bases, higher lows, and now breaks above some key levels. In Carnival, watch that $12 level. Norwegian, their numbers have been fantastic, and if you look at their numbers before 2019, they're up. They're up 30% from 2019 pre-COVID. So price hasn't followed yet. They have a long way to go, but I'm seeing progress, and the sailing ahead may be smooth, to continue on that pun.
All right, Jay, final question here as we get prepared for this long weekend, the debt ceiling, X date, et cetera. You think it's going to work out?
Oh, do I think it's going to work out? Yes, I think it's going to work out. Do I hope it happens before we go away on this weekend? Most definitely. That's the one thing traders don't like, is to, you know, have to be checking their phones, checking the news over the weekend. Coming in on a Tuesday light volume could cause a lot of volatility if nothing's settled by the weekend. Hopefully they can get it done by then.
Okay, watch this space. Jay Woods, excellent. Thank you very much indeed, of Freedom Capital Markets, on this tech sector, on the debt ceiling, of course, on the prospects for these financials. Thank you. Coming up, JP Morgan telling 1,000 First Republic employees they won't have jobs as the takeover unfolds. More on that next. This is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Now we head to Wall Street, where JP Morgan notified about 1,000 First Republic Bank employees that they aren't being given jobs following its takeover of the failed lender. Joining us now to bring us all the developments, Bloomberg Wall Street correspondent Sonali Basak, waking up early for us and joining us on set. We kind of knew this was coming, right? This happens when there's mergers.
Certainly, when there's mergers, not everyone can come on board, especially with two banks like JP Morgan and First Republic, where there is overlap in terms of jobs. I would also remind you that JP Morgan is one of the banks that really expanded headcount pretty meaningfully in recent years, including in the tough times of the last year or so, where we've seen a lot of banks cut jobs. We know that JP Morgan's headcount has actually expanded over that time frame. Now, remember that this is about 85% of First Republic's job force here that were given either full-time or part-time jobs. One question I have, Kriti, is how many of those part-time jobs become full-time jobs, or do they start to taper off over time? I guess it really depends on what kind of business is brought in from First Republic as the integration ensues.
Yeah, and it's worth saying that JP Morgan spokesperson has said, look, it's a stressful time for them all, but at the end of the day, they are updating the employees on their status within 30 days. So worth bringing that clarity from the bank itself. Let's go to another bank here. Morgan Stanley seeing some job cuts, not stateside, but in Asia. Walk us through it.
Yeah, remember, Morgan Stanley had been undergoing a kind of more global headcount reduction to some degree here. We know they made a small one at the end of last year, then they had an additional one this year. The market has been really soft, particularly in Asia, where deals has not really started to come back. Remember, Morgan Stanley's headcount there was already larger than a lot of global peers. They have a large investment banking workforce there. But what is striking about our report here, Kriti, is that some of these job cuts even extend to people who were promoted in recent years. So that shows you kind of the extent of the pain that the market is feeling and the unwillingness of certain banks to keep staff on at scale, or at least the scale that used to be, as they look towards what the next cycle starts to look like as deals may start to come back.
And Sonali, meanwhile, in this part of the world, there's some Bloomberg reporting suggesting that maybe finalising the deal, the takeover, UBS, of course, Credit Suisse, that's going to take a little bit longer because they're having a wrangle with the Swiss government, UBS are, about this backstop.
Yeah, and that is an interesting story, especially on the talent perspective, Tom. We're talking here a lot about this top story here of UBS offering really incentives for wealth managers here, particularly in Asia. You're talking about your part of the world. Remember, there's still a humongous concentration of wealth when you look at China and the broader Asia region here. And the incentive is quite rich, if you will. It's about 15 basis points for every $100 in new client money that can be brought in. Remember that it's not usually so specific or even so large when you look at wealth managers, but it just shows you as the deal uncertainty continues on, you have UBS's top brass going to Asia and making sure that they can keep people on in this really uncertain time frame.
Bloomberg, Sonali Basak, all over the global Wall Street story. We thank you as always. Another story that we are monitoring very closely comes in the car maker space. Ford has struck a deal with rival Tesla to give its electric vehicle customers access to the Tesla supercharger network. Tesla CEO Elon Musk discussed the benefits of the deal in a Twitter Spaces session with Ford CEO Jim Farley.
I think it will not be cost prohibitive. It'll be, something that's quite affordable. In the hundreds of dollars range, it's an adapter, so it's not super expensive.
Look, Tom, this is such a fascinating story because at the end of the day, when you look at Tesla and Ford kind of combining, they are at the end of the day rivals. Ford trying to catch up with Tesla in terms of their EV scaling. So this one kind of caught me by surprise.
Yeah, it certainly seems like it's good news for consumers, right? Good news for drivers because they do have that infrastructure. And this has been part of the shift, the spending, of course, within companies like Ford as they play that catch up. But they've also needed that infrastructure. I don't know about the US, but certainly here in Europe and the UK, it does still dominate. And there is that catch up amongst many of Tesla's rivals.
Yeah, you're already seeing that getting boosted a little bit. Tesla shares higher by 0.5%. Ford, I believe, also moving on that story. So certainly some stocks we're going to be watching there. A few more I want to put on your radar, though, especially in the chip maker space. Look, we're a day out after that blockbuster move from NVIDIA shares. And you can see it is still kind of up there. 380 around is where the stock is trading, down about 0.2% in the pre-market at the moment. But look, some of its rivals, Intel, for example, which took a little bit of a hit yesterday, higher this morning, trading higher by about 0.4%. Advanced Micro Devices in that same boat, higher by about 1.2%. But the AI theme continues throughout the tech space, specifically with Marvel Technologies. And this is, for the record, not the company that makes those superhero movies, Tom. This is Marvel Technology, the ticker MRVL there, trading at about $57 a share, kind of doing the same thing that NVIDIA did. They are seeing that their 2024 AI revenue is going to double, pushing those shares higher by 16% in the pre-market. So that's your chip stories there. We're going to be monitoring that throughout the day. And of course, Gap could talk about the other side of the spectrum, the perhaps more cyclical consumer nature of the spectrum. Gap shares rising as well. Essentially the hit that we expected them to take, not that bad. In fact, they're recovering faster than expected. Those shares, GPS is the ticker, higher by about 12.5% in the pre-market, Tom.
Chrissy, I'm glad you offered that clarity because I wasn't quite sure. Yeah, Marvel the comics or Marvel the tech and AI, and it's the important AI one that we're focused on. It is important. Thank you. Right, coming up, US Treasury cash balance shrinking to below $50 billion. More on that next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
While inflation is still too high, there are some promising signs of moderation, and I believe that we may be at or near the point where monetary policy can pause raising interest rates, and this will provide an opportunity to more fully assess the impact of the actions we've taken to date.
That was Boston Fed President Susan Collins speaking yesterday in Rhode Island. Joining us now is Bloomberg International Economics and Policy Correspondent Michael McKee. Look, the default worries intensifying, the Treasury's cash balance dropping to its lowest level since 2021. What are your takeaways here? Why do we care?
Well, the interesting thing about the Treasury cash balance, as our colleague Kaylee Lyons pointed out, 24 people on the Bloomberg rich list have more money than the Treasury Department right now. So they are very short on cash, and it does mean that they're going to have to, by June 1st, either temporarily punt it down the road or raise the caps by the debt ceiling by then. They've got $101 billion in various payments, including some Social Security and Medicare due on June 1st, and they got 49. So the math doesn't work. Yeah. But the question is, do they at this point feel a sense of urgency? The old saying, nothing concentrates the mind like a hanging, might come into play here.
Can we just point out that you're wearing dollar cufflinks? How appropriate for the debt ceiling debate?
Up. Yeah, trying to keep up.
with the Treasury. Mike, talk to us a little bit about kind of what happens after this deal if it is passed. What happens when it's passed? What kind of effect does this have on the actual economy?
Well, that's an interesting question that hasn't been really focused on, because we've all been worried about what happens if they hit the debt ceiling and go over it. It looks like maybe they're not going to, so then what does this budget deal mean? Well, we don't have all the details, but basically it doesn't mean a whole lot to the economy, because they're only talking about non-defense discretionary spending, and not all of that is included. They're still going to be spending money on veterans programs. Defense spending is going to go up. The entitlement programs are still going to go up, as they automatically do. So it's going to have a very marginal effect, if any, on growth. And you always have to ask in these situations, growth compared to what? The baseline from the budget that was passed last year, they're not going to go down all that much, and it's going to be over a period of 2 years. So you really don't expect much to happen to the economy because of this.
Mike, does a deal, if it comes to pass, does it clear the way? Does it clear the path for a June hike from the Fed?
You could argue that both ways, Tom. The feeling had been that if they hit the debt ceiling and went over it, and we were in a default kind of situation, that no, the Fed could not raise. But if they do pass it, then the question becomes what happens with inflation, and it's, of course, a good question to bring up today, because we get the PCE inflation numbers coming up in just a couple of hours. And despite what Susan Collins said in that sound just before I came on here, we are not seeing any progress anymore. We had seen progress, a lot of it, in bringing down inflation. But if you look at the forecast, we're not going to see much, especially in terms of the PCE core. It's not moving down. It's kind of stuck, sticky inflation there. So the question is going to be open for a while, up until the 14th of June when they meet again, as to whether they raise or not. Something to keep an eye on.
And Mike, more broadly across this US economy, the resilience of the labour market, we saw that again with the revisions around the jobs claims yesterday. Are other areas looking more vulnerable, even as the labour market holds up?
We haven't seen a huge amount of vulnerability. We are getting to the point where companies are hiring fewer people. We don't know whether that's because they're preparing for recession or because they've finally found the workers that they needed. Because each month we're still adding more jobs than we need to account for new workers in the labor force. So at this point, we're going to be very interested in what happens next Friday to see if we do see a decline in hiring towards that level, or if we see any kind of increase in unemployment that suggests that maybe the labor market is loosening up and companies are preparing for worse times.
And of course, the economic data coming in at 8:30 a.m. today. Mike McKee will be all over the PCE numbers and the personal spending numbers. Bloomberg's Mike McKee, international economics and policy correspondent. We thank you as always. Folks, that is it for early edition. Markets a little bit sanguine today. Let's see if that changes when we get closer and closer to the opening bells. Right now, surveillance, though, is going to take you throughout at least what to prepare for, what to listen for over the weekend. Crossmark's Bob Dole, Morgan Stanley's Mike Wilson, and Megan Green of the Kroll Institute all joined the program, as well as I hear a guest from Formula One. Interviews you do not want to miss. Stick with us. More surveillance ahead. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
If you look at tech, it continues to reinvent itself over and over.
People are jumping on the stories that look sustainable.
The big picture here, I think, in terms of the economy, is it continues to expand.
There's no way, in our opinion, that the Fed is going to be easing financial conditions anytime soon.
I think they probably try to hold all year, but then next year start to cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Bramo is away, so this show is going to be totally unhinged for 3 hours. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Your equity market just slightly soft and negative on the S&P 500, down a touch after AI went absolutely nuts yesterday, Tom, in the stock market.
Really historic day. I think Lisa really grabbed it earlier than I did. I mean, the scale of the move is extraordinary. Let's pause for a moment on that. A very important Friday here and some terrific guests coming up. The pros look at standard deviation jumps. It was a 4.4 standard deviation move. Jump up in NVIDIA. And what I was unprepared for, John, is you go to the MEMB panel on the Bloomberg and you look at the NASDAQ 100, and, you know, I sort of frame in my head, John, 25%, 27% of the big guys, gone. That's ancient history, like 6 months ago. Line them up. Microsoft, Apple, now NVIDIA, brand new, Amazon, Google, Meta. You ready? 51% of the NASDAQ 100. Never have I framed that, let alone said it.
Year to date, the NASDAQ 100 up about 27%. But some of these names, listen to this. NVIDIA, year to date, up about 160%. Meta, year to date, up about 110%. Great note from Michael Hartnett over at Bank of America this morning. The title, Bonds and Bubbles. He said 4% real yield popped the internet bubble, 3% pop subprime, 250 crashed crypto. The market is saying 150 basis points, Tom, too low to pop AI.
Yeah, well, to pop AI, I'm not sure where to go with that. I really haven't framed out my head. Alec Webb in London, I thought was absolutely brilliant yesterday, John, on this NVIDIA AI stuff. What I will say is once we get beyond the debt ceiling, are we this weekend, then we go back to normal interest rate analysis into the June 14th Fed meeting.
So publicly, lawmakers are insulting each other still. The Democrats blaming the
It's a bigger group of people that need to be sold, whatever the toxic brew they're doing this
You
weekend.
count the officials, I'll count the cash at the Treasury right now.
Yeah, please.
Treasury cash balance, latest data, a break of 50 billion. A break of 50 billion, a break below that level. So down from more than 76 billion just the previous day, Tom. So that number's come down. I get that it's lumpy, it can jump, it can fall, but ultimately you can see the trend. 2 weeks ago, from 140 in the middle of May down towards below 50 billion.
As we get started on this important Friday, I'm going to go idiosyncratic on you. John and I have different launch pads, different screens that we use in the Bloomberg for equities, bonds, currencies, commodities. Out of left field, but I'm sorry, it's a number that sticks out like a sore thumb today. You mentioned South Africa yesterday, unwinding. It's like Dow 10,000, Turkish lira 20. That's a new thing. That's a weaker lira, given the electoral drama that you're seeing in Turkey.
Let's whip through the price action and move on from that. Your equity market more broadly on the S&P 500, negative 0.14% on the S&P. Yields come in just a little bit by about 3 basis points. The 10-year at the moment, about 378.28. A lot of focus on the euro, trying to stage a bounce and recovery. Yes. 107.35. Fact of the matter is, we got down to lows we haven't seen since March recently. Very, very close to breaking 107 in yesterday's session.
I looked carefully. We did not break 106 once, twice, 3 times. Maybe today.
Maybe. We'll see if that dollar strength comes through. Bit of economic data coming up a little bit later. Look out for that. We'll get personal income, personal spending at about 8:30 Eastern time. Get a whole load more at about 10 a.m.
I missed that.
You Mitch sentiment survey coming out before you can enjoy the long weekend. Before we can enjoy the long weekend as well here stateside, Daniel Ricciardo coming up a little bit later. F1 driver Danny Rick.
More than that.
40 minutes away.
To the American audience that may not be familiar with this truly international name, this guy is a star, and it's his character. It's not just driving around. He did the same thing. They all started out at 7 years old. He was near Perth, Australia. He's Australian-Italian.
He is. Speaks Italian too.
Does he speak Italian?
I often thought that he might end up in a seat over at Ferrari. But maybe it's too late for that.
I think there's a lot of speculation about like what's next, but we'll get to that later. But this is going to be fun. This is a guy that's taken the brand further. Imagine that. I mean, he's a little bit like Michael Jordan in basketball. He's done more than just bounce the ball, drive the car.
He's a real personality. He will be the second best guest this hour. The first best joins us now. Bob Dole, CIO at Crossmark Global Investments. Bob, buddy, good to see you. Going into the long weekend, let's start with that rip-roaring rally in big tech and AI. Is that something you're willing to fight right now?
No, not really. Look, into strength, you do trim and trying to buy into weakness. But look, the NVIDIA numbers were off the charts, and that carried the day for technology. My problem is everything else. The average stock year to date is down. The Dow is down year to date. Russell 2000 down. 8 of the 11 sectors down year to date. This is a very narrow and getting narrower market, and that's generally not healthy.
Bob Dole, within your history, do you have an analog? Is there another time that looks like this?
Well, we're not there yet in terms of either valuation or narrowness, but into the 2000 tech peak, there are similarities beginning to build. I hope it doesn't end the way that one did, but we've got to watch it carefully.
Yeah, I look, Bob, at the choices that have to be made, and you're going to make them over a 3-day weekend. You're going to reallocate into June. You're going to reallocate into a mid-year review June 30. How do you reallocate in equities?
So what I've been doing, back to the first question, is into strength, continue to trim tech. And my biggest ad in the last quarter has been financials. Those stocks have been decimated. I'm not trying to figure out, which community bank's going to make it, but the big banks that do not have asset liability mismatches, that have good credit, they were taken down big time too. So having added to those, thinking there's more juice to come there.
Bobby, you're talking about some banks like JP Morgan with both the investment bank and a large presence in retail as well. Is it more specific, Morgan Stanley, Goldman Sachs? What names are you thinking about here, Bob?
JP Morgan, top of the list. Citicorp, Bank America, they're the kind of names I'm adding. Already own some Goldman and some Morgan Stanley.
When you look at the community banks, I mean, one thing to do there is an ETF, something like that, the Keefe, Bruyette & Wood Index or so. Do you suggest, instead of cherry-picking community banks, looking at a broad portfolio?
You could do that. Look, I don't think we're out of the woods yet. When the Fed raises rates from 0 to 5% in 13 months, there are consequences. We've seen a few. I suspect the banks are not out of the woods yet. So be careful how fast you go.
Talk to me about preferreds. It's fossils like you and me, Bob. We remember when preferreds were talked about all the time. I think it's much less so now. That extra dividend in preferreds, does it have value?
Yeah, I think it will assuming we get into a more defensive environment. We have obviously had a period when both preferreds and yield stocks year to date have not done all that well. That's because we're in an environment where interest rates have moved up. If we can go sidewise for a while and the equity market kind of gets a little sloppy, probably preferreds and dividend yielding stocks do better.
Bob, what would you say to people who have missed out on this rally year to date and are starting to feel anxious about getting in and deploying capital? What's your advice to those people?
Well, first of all, have they really missed the rally? They may have missed the stuff that's up, but the average stock to repeat is down. I wouldn't go chasing a whole lot here. I still think economic weakness, mild recession is in front of us. I know that's a minority of people now, but earnings have not behaved themselves all that well. After a better than expected first quarter, you would have expected a lot of analysts to move their estimates up, and it's been spotty in that sense. And I look at my screen, and the stock market's selling at 21 times earnings. So it's not like I'm getting a bargain to take on some of this I really don't know risk.
Are you still advocating for some form of cash position? And if you are, Bob, how big?
Yeah, look, most of my portfolios, I'm to be fully invested. I have some long-short portfolios where I do have some cash. When you can get 5% on cash and you're uncertain about earnings and your PE is over 20, having a little cash in your portfolio, whether that's the fixed income portfolio part of your portfolio or the equity part, I don't think is the worst thing in the world.
Hey, Bob, good to catch up. Good to see you. Enjoy the weekend,
Have
sir.
a good weekend.
Bob Dole, thank you, of Crossmark Global Investments. Talking about yield, at the moment, 4.49 on a 2-year. Yesterday through 4.50, we had 10 consecutive days of yields rising at the front end of the yield curve. This morning, we come back down by about 4 basis points, but let's call it 4.50, Tom. Again on a 2-year.
I know you're house hunting this weekend, John. 30-year bank rate. I mean, it's a moonshot. I can't count it right now, but it's up 15 days in a row. Let's guess, rounded up 7.15%. And we have just, yes, we've just exceeded the peak of March.
This happening in real time?
In real time. 30-year mortgage, we've just exceeded that peak in March. Mortgage rates are now, based on the bank rate, 30-year mortgage, higher than they were at the March peak.
We've said it how many times? If you got that mortgage 30 years at 3%, you're not letting that go, are you?
This is original. I don't think I can say in any other housing crisis we've seen this.
But I think the whole thing's original right now. Just look at the data that's coming out of manufacturing versus the data coming out of services. The distinction there is just massive. Manufacturing worldwide, Europe, China, US, screaming recession. The services, take a look at airlines. I've had a lot of people reach out to me in the last 24 hours about how busy the airports are going into this weekend. That doesn't look like recession at all.
I talked to my driver today. The Bentley was in the garage, and he said the Hamptons will boom this weekend. He's spending the entire weekend in the Hamptons. He said it's back to 2019.
I'm going to say something that's very foreign to people who live in New York.
Right.
What is it about the Hamptons? What is it about?
I
just don't get it
either.
I don't get it.
No, you're correct.
The beaches are, I'm sure I'm going to offend so many people who spent a lot of money
there's some
on
nice
houses.
beaches.
They're not that spectacular.
Well, you know, what do you
$100 million
compare him to?
for a house
Excuse me,
on a
guys,
beach.
this is a guy with 4,000 square feet in Capri.
You can go to Capri or Ischia, anywhere on the Amalfi Coast, and pick up a house, a villa, that you can do up for, let's say, several million. Go and have a look at how much it costs to pick up a house in places like Southampton.
I was going to say a shack.
We're talking 50 million, 75
John,
million
I can
for
see
what?
you, John. I can see you up the Hudson River, off to the refs.
No, thank you.
My friend Emily's running a grocery store.
Anyone who's thinking of doing that, just send me a message. I'll do this for free. I will construct a global property portfolio for you for the same money that you're about to spend 100 million on a place in Montauk. I don't get it.
John, what this could be, instead of Happy Friday, we could say Happy Tuesday. Come back from Memorial Day.
Go to the Jersey Shore. What's wrong with that?
Happy Tuesday.
Happy Tuesday.
Yeah.
Coming up shortly, Jeanette Lowe of Strategas on the debt debate in Washington. That's next.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. And another Republican may be gearing up to enter the 2024 U.S. presidential race. The Wall Street Journal reports North Dakota Governor Doug Burgum is planning an event on June 7th to make a major announcement. Burgum's a wealthy former software entrepreneur who was first elected in 2016. And Bank of Japan Governor Kazuo Ueda says the BOJ's balance sheet isn't necessarily in a normal state, given the bank's large holdings of government bonds and ETFs. Ueda also played down the importance of wages or any single economic data set as a trigger for change. This suggests his desire to hold on to policy flexibility, leaving speculators guessing about the timing of policy shift. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
At the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. The debt ceiling deadline closes
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
Speaker McCarthy and I have had several productive conversations. The American people deserve to know that the Social Security payments will be there, the Veterans Hospital will remain open, and that economic progress will be made, and we're going to continue to make it. Default puts all that at risk. Congressional leaders understand that, and they've all agreed there will be no default.
The President of the United States with a touch of happy talk going into the weekend. There will be no default. The latest news, the reality check, just follow the numbers. This from the Treasury cash balance going into the weekend. The cash balance dropping below $50 billion, according to the latest data. That's down from more than $76 billion the day before. The contours of a deal reportedly coming together based on the reporting of Justin Sink and our colleagues down in Washington, D.C. According to people familiar with the matter, the two sides have narrowed some of their differences in recent days. Negotiators, Tom, said to be moving closer to an agreement to raise the debt limit and cap federal spending for 2 years. We're not there yet, but we're getting closer, apparently.
And where are we yet, too? And what the conservatives are going to say is, okay, we're there, but just as you said, the key phrase is 2 years, or maybe it's 18 months, maybe it's 3 years, whatever. But it seems like it's almost a collegial Band-Aid to not kick the can down the road, but to have a termination date out there. That's what I'm going to be looking for, is what are the termination dates out?
Ultimately, the consensus view is, Tom, we'll be doing this at some point further down the road, regardless
well,
of how much further down the road it will be.
I think we've done it 78 times or whatever since World War II. I can't remember the exact statistics. 1960, I believe.
Yeah.
But, we do this every 3 or 4 years, to say the least. As you go into the weekend, 3-day weekend, long weekend for politics in Washington, they will look at policy and the outcomes of it. Joining us now, Jeanette Lowe, Managing Director, Policy Research at Strategas. It is a Baird company. Jeanette, what is a distinction for you? What will you listen for this weekend?
So first, thanks for having me. So we do have a deal coming together, which is good news. There are still a lot of details that need to be worked out as you continue to hear that they've made progress, and they are limiting the number of issues that still need to be taken into account and finalized among the negotiators. So it does seem like we are getting closer. We're definitely going to be looking at how this deal is structured. This is definitely smaller than what the Republicans initially proposed. They were looking at 10 years of discretionary spending caps. We might be more at 2 years. So how that's going to be structured is going to be important, I think, for the markets, because there is this anticipation that we're going to get some austerity out of this deal. But even if we don't get austerity out of this deal, we still think there's more fiscal austerity in the years ahead for the United States. This
is really, really important. You went right where I wanted to go, and this is literally the history you learned at Richmond and BU. What's the difference between our austerity and what, say, the United Kingdom is living? They seem to be drowning in an austere psychology. I don't see that in the last 8 or 10 years in Washington. I see, if it moves, spend it. Spend every dollar. What's changed?
So what we've seen is that, obviously the pandemic, you had extraordinary fiscal stimulus come into and that the government provided. And then obviously we've had inflation come on top of that. What's really been the key change now, because to your point, we have been able to just spend and cut taxes quite freely for the past number of years. But now that we've had interest rates rise so much, that is now increasing the cost of the U.S. debt. And so net interest costs for the U.S. are now increasing. We have seen historically that once those rates hit 14% of tax revenues, financial markets begin to impose austerity on policymakers. We are currently at 12.7%, and we anticipate that we will get to 14% by the end of the year. And so that is where we're really looking. That's going to start to squeeze the federal budget. So even if this deal is not particularly austere, which given the current contours, it doesn't seem like it will be, we are still looking at the fact that over the next couple of years, the policymakers still have a number of other times that they're going to have to come into play to think about how do they bring the U.S. fiscal budget into a better alignment to kind of handle some of these costs that they're dealing with.
Jeanette, can we just finish on the X-date, the so-called X-date? The Treasury doesn't have a precise idea of when that falls. We're all guessing here. They have some information about tax receipts. It can be very lumpy sometimes. How are you reading the tea leaves of that situation?
Right. So, I mean, I think all the negotiators want to operate off the fact that we have June 1st as the X date. Now, there always is a little bit of flexibility with that. Treasury wants to have a little bit of a buffer so that if we were to cross over the X date, you would still have maybe some cash to still continue to make payments before the Treasury Department would actually run out of cash. Maybe they might be able to make it to June 3rd, maybe not. They did put out an auction this morning that does make it seem like they might have a little bit more cash at the X date. But I think the more important thing is that the negotiators are focused on the X date. And if we were to cross it, we do think that would be quite a market jolt. It would actually help get a deal if we still hadn't gotten one at the same time. But I think that the actual loss of cash is less important than that X date right now, just for policymakers to be able to control their focus.
Jeanette, just to finish on that point, when they start to think about prioritizing spending, I think there can be some confusion between going through the X date and defaulting on debt obligations. They can be two different things. How do you think the Treasury will start to prioritize spending if we go through that date?
Exactly. It's a great point because the big thing that we have been trying to focus on is the fact that this would actually not be a default if we crossed over the X date. Treasury, we believe, would prioritize making interest and principal payments on treasuries. This would be more about prioritizing spending and payments to bills that need to go out at some point. We still think that the Treasury would prioritize things like Social Security, Medicare, defense, but then it's about whether or not you pay some other federal contractors on time. So it seems more like what we would see when we have a government shutdown with trying to move payments around, but it's not an actual default on U.S. Treasuries.
Jeanette, thanks for clearing that up. Appreciate it.
Fabulous.
Just brilliant. Jeanette Lowe there of Strategas. That final point's a really important one.
Yeah.
There has been some conflation between going through the X date and defaulting, Tom. They're not the same thing. They don't have to be the same thing.
I'm really proud of what our team's done on this. Maya McGinnis has been with us, and now Jeanette Lowe. What she said in the middle of that interview, folks, tattoo it to your brain. She said, we're moving from 12% to 14%. And the CBO, this is like the adults, the CBO, forget about the politicians, says in 2053, 38% of our interest expense, 38% of our taxes are going to go to interest payments. That's how out of whack this is. We're trying to get out to June or get out 2 years, as you just said. CBO says we're going to go from 14% of tax revenues to pay the interest bill to 38% in 2053. You and I are going to be on set in 2053. I'm going to be 20 years to that Austrian bond. And the interest math doesn't work.
I'll say this about that. Tom, the problem here is that we're becoming more like Europe, but without the nice trains. It's not pretty. It's not good. And once you get through this, it doesn't mean that the debt conversation goes away. There needs to be a real conversation about this. I think there's been a total failure of those who care about this issue out of power, forgetting about this issue when they come into power. And this is something that, Tom, that quite clearly needs to change based on the trajectory that we're on.
Certainly the recent catalyst was a medical event, a pandemic. Everybody can, look back on history. Books and books will be read. But we had this natural disaster. And now we got to come out and that and get back to the austerity Ms. Lowe was talking about.
And government spending some significant money worldwide off the back of this natural disaster, which makes me wonder, Tom, why there isn't a bigger willingness from governments worldwide to really get to the source of that natural disaster, to understand what was behind it, what happened. I'm still surprised by that today. The almost lack of interest to get to the bottom of that when it's cost global governments so much money responding to it.
I agree, and the question is, how do you prepare for the next disaster? And I don't hear much conversation about that right now.
Very strange, isn't it? A lot of distractions at the moment. Here's one for you. Equity futures on the S&P, negative not even 0.1% on the S&P 500. Great lineup this morning. Dom Constant of Mizuho on this bond market, on the Federal Reserve and the global economy as yields retrace some of the move of the last 10 days after going through 450 on a 2-year. This morning we're down about 5 basis points. Your yield at the moment about 448. From New York City, going into the long weekend, this is Bloomberg.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Let's get you to the long weekend stateside. Your equity market on the S&P 500 trying to stage a recovery, just about unchanged on the S&P. Down on the week by about 1% so far this week through Thursday. The Nasdaq slightly positive. The Nasdaq 100 yesterday, best day of gains so far this month, in the month of May. Even with this in the bond market, 2-year, 10-year, 30-year shaping up as follows. 2-year around 450. We've had 10 consecutive days before today of yields climbing, yields dropping today by 5 basis points. But still, over those 10 days, with yields up something like 50 basis points, call it 60 basis points higher, the Nasdaq 100 is up 4%, more than 4% over the same period. That rate story, Tom, hasn't taken a bite out of the enthusiasm in the equity market.
And the enthusiasm of pretty good GDP numbers, including the second view we saw in first quarter yesterday. John, further inversion now, and I don't know if 70 basis points of inversion's out by near 100 basis points, but the trend's in place. And the real yield, John, the 10-year real yield, 1.53%. That is a change from 7 days ago.
Looking at the nominal yield week to date so far, up something like 22 basis points on the front end in the US. In the UK, we've had a 58 basis point move this week.
Yeah,
at the front end of the
I'm glad
yield
you
curve.
mentioned this. Germany, too.
CPI, hot. Pressure on them to hike again. So some really interesting moves in the FX market off the back of some of this too. So let's finish on the euro against the dollar. The euro against the dollar right now at about 107.33. Yesterday coming really, really close to a break of 107 after getting close to breaking 111 not so long ago. Yesterday, the low of the session, Tom, 107.07. Not too far away from talking about 106 going into this weekend.
I mentioned a couple days ago, technically a free fall from 107 to 105. We're not there yet, as we haven't breached 107. It's going to be an extraordinary day. I'm nervous. I'm reading auto. Got Ricardo coming up here.
Very cool.
So we got a bigger superstar than Ricardo coming up right now.
Dom Constant. Are you saying Dom Constant's a bigger guy than?
Yeah, he's huge.
Than Danny Rick.
Yeah, Dominic Constant is.
Do you want the good news today?
Yeah.
And it's the long weekend. No Fed speak. No Fed speak whatsoever from Federal Reserve speakers. They take the day off going into the long weekend.
Yeah, but when Dominic Constant talks, it is Fed speak. He's that influential.
Dom Constant's got to say over at Mizuho on all of this, the Fed speak we've heard so far this week. We still expect the Fed to pause officially in June, and the next move will be a cut. The credit crunch is slowly beginning, and as long as the layoff rate continues to rise, there is scope for a sharp rise in unemployment on the back of lower vacancies. That's certainly not what you saw in claims yesterday, but this is the conversations people are still having, Tom.
There was a conversation 90 days ago, out front 100 days ago on this was Dominic Constant of Mizuho Americas, certainly lean forward global Wall Street. And let's get an update right now. Dr. Constant, it's real simple. There's two Americas out there. There's everybody else flat on their back, and there's people that own NVIDIA. They're all out in the Hamptons celebrating this weekend. What does your super restrictive take on the Fed mean for the Hamptons? I'm fascinated by where we are, your super restrictive Fed, and where we're going to be when the first leaves fall in the Hamptons in October.
Well, yeah, I think this is kind of the calm
before the storm, so to speak. Nothing really has changed over the last few months in terms of the underlying trends of a slowly slowing economy. Basically, you are having credit conditions obviously tightening, and lending growth is slowly slowing. And a number of things in the pipeline, such as when the debt ceiling is passed and a lot of T-bill issuance takes place, that will kind of challenge, if you like, the banks again in terms of potentially losing more deposits. And so I think the idea is just a question of patience. The immediate crisis, whereby in some sense the Fed needed to cut rates, let's say, at the June-July sort of meeting, obviously that's all backed off now. But it doesn't mean that the underlying problems have suddenly sort of gone away. They're still there. And as you say, the real risk is that the unemployment rate rises much more sharply towards the end of the year, and that will have a whole new meaning for the Fed. Right now they can fight inflation because there's that's the main issue. There's nothing else seems to be a problem, but it will be a problem if unemployment starts to rise faster than most people expect.
What is the rate of change on that? I mean, do you expect, this has been a debate on the show, Dominic, the basic idea of non-farm payrolls, 220, 230, 250,000, everyone agrees it's coming down. But what do you suggest will be the way it will come down to 40,000, or dare I say a negative non-farm payroll statistic?
Well, the issue really goes back to a debate that the Fed itself had, Governor Waller had with Larry Summers, in terms of you can think about how unemployment rises. It rises either because demand for labor is going away. It can rise also if the supply of labor is going up due to people getting fired or rejoining the labor market. The issue is what happens if both happen at the same time. If people start getting fired and that demand is going away, and the demand is reflected in vacancies. So I think the path, you could see quite a sharp rise in unemployment as those two things collide. And those are the very statistics that Governor Waller himself put out in the paper with Andrew Figueroa in July last year. And they had an example where a 50% jump in layoff rates could lead to unemployment essentially doubling from these levels. So I think the path, if you like, for a quick drop in payrolls around, say, end of Q3, Q4, is certainly plausible. And that, as I said, that would the Fed historically starts to cut rates when unemployment only rises on average 22 basis points. That's for the last 5 cycles. They don't need much of a excuse to start cutting rates if unemployment really starts to rise as much as some of those indicators would suggest.
Isn't it the objective now, though, Dom, to see that happen?
Well, yeah. I mean, that's part of the problem. I mean, inflation is sticky. We all know that. I think most of us sort of understand why it's sticky. I think it's to do more with the supply side rather than demand side. The Fed, it can't be patient really if unemployment's so low. So it kind of needs to see the unemployment rate rise. It's obviously now got the credit tightening on its side for that. And then they can kind of switch gears. But until it does, it doesn't have much incentive to really sort of preempt any kind of loosening up of the labour market while inflation is still sticky. And you mentioned the UK data. I think a lot of people were a bit surprised by that, not just because it was higher than expected, but the goods side was higher. And you saw yesterday Fed officials were talking about concern around goods inflation not perhaps coming down as much as they might have expected in the last couple of months. So those all kind of feed into this sort of nervousness around inflation being still a bit too high. It's got to come down. And if unemployment's still low, then you just keep on fighting it. And it doesn't mean you keep raising rates, but you certainly have a pause and say, I may have to come back and raise rates again if unemployment's still where it is and inflation is still where it is.
You clearly have a different view on where unemployment is going to go from here, looking for some pretty soft prints on payrolls. You mentioned vacancies. Can we just talk about that conceptually? Don, we saw a lot of reports, a lot of studies done over the last 6 to 9 months, some people leaning on this idea that you can have vacancies come down without unemployment going too much higher. What's the reality check to that, Dom?
Well, I mean, the answer is no one really knows. Empirically, it's definitely true that if you go back through cycles, as vacancies come down, unemployment does rise quite a lot. COVID was so amazing in terms of how the labor market restructured. Companies were getting rid of people in one part of the country and rehiring people in another part of the country. The whole efficiency around the job market basically was temporarily destroyed and has been reshaped. So the truth of it, no one really knows. But there is obviously some good sort of theoretical arguments on the side of the Fed that you could get vacancies coming down quite a lot without necessarily having unemployment go up a lot. And then obviously some people, more people like myself, so we tend to rely perhaps more on historical models and the idea that if you are going to get a slowdown in vacancies, then the bias would be the risk is that unemployment just rises a lot more than you think, especially when you have this restrictive policy in place by the Fed. They're not really leaving themselves much wiggle room.
Dominique, you're so cut and chiseled. People don't realize how many years you've been around. Out of Cambridge and Oxford in the 80s, your first day at Credit Suisse, I think it was in the 90s. And it's real simple. I'm looking at the chit-chat we have to put up with every day, from, say, Austin Goolsbee of Chicago over to James Bullard of St. Louis. Are these people talking too much?
Yeah. Well, I mean, yeah, they're certainly talking a lot. I mean, the question is whether it's sort of helpful, I guess, for the markets. I mean, in my mind, it's a lot of noise. I think in general the governors are good people to listen to. I would sort of, I like the governors. I think the presidents can be a little bit sort of just a lot of sort of white noise around the whole conversation. And especially if they're not voting, it's much less relevant for markets, obviously. 12
months out, 24 months out, where's the 10-year yield? If we move from a constant super restrictive to something new with a labor deterioration, where's the 10-year end up?
So I think the key thing is really what happens to the supply side, the supply-driven inflation that we're observing. It's still very high. My guess is a lot of that is still kind of COVID pandemic related, and that will dissipate, especially as you see the labor market normalize. And on that basis, 10-year yields should come down to 3% or below, because the Fed needs to be getting back to the neutral rate, which Williams now confirms isn't very different from what he thought it was before.
There's that headline a couple of days ago.
Dom, I can't let that go.
Yeah.
What did you make of that?
Yeah. But anyway, the risk is obviously stagflation, and that supply inflation doesn't come down. And we've done some detailed modeling on that, which suggests the 10-year kind of stays where it is. It's like a 3.5–4% kind of yield. It's no big deal, which just means the upside to 10s is probably capped. I mean, you're not going to see a sort of 5–6% yield. Talk about the federal interest cost. You certainly don't want to see that on a sustained basis.
Hey, Dom, I'm not letting you go without answering. What did you make of that Williams piece?
Well, I mean, I'm not surprised. I mean, I think if you massage your data enough, you're going to get the result you kind of want. My intuition is that he's
Can
probably
you be clearer,
right.
please?
No, I mean the low era of interest rates, that we saw before the pandemic, it hasn't suddenly changed because of the pandemic, I think, and statistically, obviously he's able to show that by doing some sort of more fancy kind of econometric kind of analysis. Yeah, I mean, we'll see. I sort of my bias is that the low era of interest rates hasn't changed anyway. I think there's a lot of reasons why people are worried about it changing, but I think no one really knows. I'm happy to run with the flow.
I think the invitation to Jackson Hole just went out the window for Dr. Constam.
Hey, Dominic, thank you. Dominic Constam there from Mizuho. I do know a man who thinks it has changed. Mohammed Al-Arian thinks it may have changed.
Yep.
Going to catch up with him a little bit later this morning.
This debate, folks, from Blanchard to Rogoff, they started it. Everybody's on board. Constam and Al-Arian in the camp with Ken Rogoff.
Coming up, absolute rock star of the F1 grid. Coming up next, Red Bull Racing's Daniel Ricciardo ahead of this weekend's Monaco Grand Prix. That conversation up next.
Keeping you up to date with news from around the world with the First Word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for up to 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. And Turkey's central bank has kept its benchmark rate on hold at 8.5% for a third month in a bid to stabilize the lira. The policy decision comes ahead of Sunday's runoff election. President Erdogan is looking to extend his two-decade rule after leading the first round of voting, but failing to take 50% earlier this month. And the cyclone that devastated large parts of New Zealand's North Island in February has been less inflationary than first feared. The RBNZ initially estimated Cyclone Gabrielle would add 0.3 of a percentage point to inflation in the first and second quarters. The central bank has since downgraded that impact to 0.1, saying while it drove up food costs, it didn't affect other goods. Bloomberg has learned that UBS and the Swiss government haven't agreed to the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules as well. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
While inflation is still too high, there are some promising signs of moderation, and I believe that we may be at or near the point where monetary policy can pause raising interest rates, and this will provide an opportunity to more fully assess the impact of the actions we've taken to date.
Well, some good news. That was Susan Collins, the Boston Fed president, by the way. Here's the good news. No Fed speak today.
Yes.
Going into the long weekend. We're kind of done, Tom. We don't have to talk about the Federal Reserve and interest rates anymore.
You know where I stand on this.
All finished up, wrapped up, finished, done. Wonderful.
Done. Announcing Peter Orszag at Lazard. He will take over the reins from Ken Jacobs. This is widely expected. I've known Peter for years. He is a world-class economist out of London School of Economics and brings John, major policy cred in healthcare toward the Lazard boutique as well. We're going to get to this very quickly because every moment's important in Monaco, and John Farrell's far more abrupt than I am. All I can say is in every sport, there's someone that transcends the day-to-day grind of the sport. You have your heroes. Maybe it's Michael Jordan in basketball. Maybe it's a guy named Judge for the New York Yankees. Daniel Ricciardo is so large for Red Bull and for F1 racing. Anne Hathaway keeled over at the Met Gala when she met him the other day.
I bet she did.
Anne Hathaway fell, Ivan Goodson, fell apart on meeting Daniel Ricciardo.
We're saying here that Hathaway was the fanboy here, not Daniel.
You know, what the problem is, he's wearing Tom Brown at the Met Gala. Thank you, Vogue, for the images. And he puts on a fake bow tie. Can you talk to him, John, when you're in Monaco this weekend, We need Ricardo in a real bow tie, not a pretend bow tie.
Tied by you. We can talk to him right now. Daniel, I'm pleased to say, joined us going into the race weekend in Monaco. Daniel, wonderful to catch up with you, mate. Just talk to us about how special race weekend is in Monaco.
I thought we were just going to talk about bow ties. Well, all right, let's talk about Monaco. It's, put it this way, I've been coming here now for 13, 14 years, and it doesn't get old. Like that feeling, I don't know, Monaco is just, it's so special. It transforms into this, honestly, like this magical place for the race. That rhymes. And you have to, I feel like everyone has to experience a Monaco Grand Prix at least once in their life. It's pretty surreal.
Daniel, just to build on that, one theme for us, as we've discussed, Formula One, its explosion in the United States with your boss, Mr. Horner, others as well, is whether we risk losing the heritage of the sport as we expand in places like Vegas, Miami, and elsewhere. How do you feel about that?
I think there always, I think, needs to like remain a place for the, as you say, like the historic venues. Your Monaco's, your, I guess if it's Spa in Belgium or Silverstone, Monza. So these places for me should always have a presence on the calendar. But I also love going to new places. And I think, how we're able to open ourselves up to new markets now and see the growth in the States. For me, I love, because I really enjoy spending time in the States. So having like 3 races there is pretty unreal. So I'm somewhere in the middle where I'm definitely open to having new venues, but I think you still have to keep those core few. They shall always remain.
If we can, I'd love to talk about your future as well. You're a super charismatic guy. Your personality, as I'm sure you're aware, has transcended the sport with what's happened on Netflix and beyond. But Daniel, I know deep down you're a racing driver. And I want to understand from your perspective how frustrating it's been, just being on the outside, on the fringes of the sport, being the reserve driver, what it's like being in the simulator, is if it's anywhere near to what it's like actually sitting in the car.
I think this year certainly serves a purpose for me. I did need to kind of, I guess, remove myself a little bit from, literally, I guess, from the driver's seat, just to, in a way, like in simple terms, probably just fall back in love with it again, and to really like miss the sport. I'd come off like a more difficult kind of 12, 24 months, like competitive wise, and I was starting just to have too many bad days where I needed a bit of a reset and a refresh. So I'm getting that this year. Sure, it is frustrating to be on the sidelines and to watch, but that's also building like this fire and that desire back. So the plan is to find myself a seat next year, and but I don't want to just be there. I don't want to just get a seat. To say I'm an F1 driver. Right. I certainly want to find my way back to a podium.
Hey, Daniel, you're in the in-between age. I mean, I don't know much about F1 driving, but I've got Alonso making a splash this year at 40-something years old. You got a lot of young Turks following behind you. Tell us the experience value, whether it's Miami or Monaco. What do you sell to a new team or even to Red Bull when you've got a lot more experience? How does that matter in a given race, including this weekend?
Yeah, I think the experience is, I think in this sport as well, a lot of sports, but it's very valuable because, it comes in terms of on driving, on track situations. Of course, the more you can read a situation, then that can obviously help, but also then building a car or helping the guys that build the car and design the car, helping them with feedback and understanding. This helps the team ultimately progress and move forward. So that's the value, I guess, in experience. I'm 33 at the moment. As you mentioned, Alonso, he's in his 40s now, and he's having one of the best years of his career. So that's encouraging for me, because there is days you feel a bit old, but then seeing someone like him, you're like, oh, I feel young again. So
yeah,
It's look, at the end of the day, it's how bad you want it. And look, I'm still in shape, and if I want it, then I believe I'll get back to it.
I'm the ugly American learning about Formula One, and John Farrow's been great about explaining to me the Red Bull distinction. I was comparing them to the West Coast Eagles of Australian football, who are in last place right now. You've been Red Bull since you were like 15 years old, 16. What's the Red Bull pixie dust?
Well, I don't know if that was a jab at me, because I love the Eagles, and yes, they're having an absolutely terrible season. But yeah, Red Bull certainly, they're the opposite right now, and they've been, look, for me growing up, they were the program. You know, that was the franchise, if you will, that everyone wanted to be a part of and sign for. You know, they had all the resources to progress you up the ladder if you were having the results. So that for me is like the family that gave me the opportunity, and now being back in the family, it's like, it feels like it's the biggest family I've ever had in racing, and the place where I feel I belong. So right now, like that's my dream, is to be back here with this team racing and hopefully winning another Monaco one day.
You think there's potential to get a seat again at Red Bull Racing, Daniel, or are you looking elsewhere?
I think, look, in this sport, I know things can change so quickly, and even at the end of 2018, you know, when I moved on to Renault, people probably never ever thought they'd see me wearing a Red Bull polo shirt again. So things certainly change and can happen. So never say never. I'm also just like, look, if I focus on myself and apply myself and keep training, keep working hard, then anything could happen. So yeah, and it helps when you got, you know, good looks in this sport. So
of course,
that's what they say.
Like Charles Leclerc. I was just wondering, I know you speak a bit of Italian. You've got that Italian blood running through your veins. Can you imagine being in the red outfit over at Ferrari?
Again, never say never. I feel like it probably would have happened by now, if it would have. So yeah, that one's probably more slim, but honestly, I'd love to be here. That's where I'm at.
That's a nice place to leave it. Daniel, this was a pleasure, a privilege. If you make it to New York, drop by. We'd love to catch up with you. Daniel Ricciardo there.
Yeah, bring Anne Hathaway. Racing.
Of course, bring Anne too. And TK's going to teach you how to do it the bow tie.
Yeah.
TK, what a legend, what a great guy.
What I would say here, and folks, I'm a complete amateur at this. John's teaching me this stuff as fast as he can. Last race, when Verstappen, a colleague of Mr. Ricciardo's, went by those two cars on like the straightaway, you could just see their cars different. He went by
so
two
much
people,
faster.
like it was just flew by him.
Looking forward to the race this weekend. The race itself can be a bit of a procession, but qualifying could be pretty interesting.
Well, qualies today start, I believe, like 12 noon or 1:30 our time.
Going into tomorrow.
I mean, start like pretty soon. Excuse me. They start at 1:30 Monaco time. So you and I can be watching the qualies in the 8 o'clock hour.
Practice
They
and
say
then
that
qualifying.
right? Qualies. That's
practice then quali.
Oh, practice and then quali.
You do practice
Screw
first.
that up.
Anyway, from New York, this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Look at tech, it continues to reinvent itself over and over.
People are jumping on the stories that look sustainable.
The big picture here, I think, in terms of the economy is it continues to expand.
There's no way, in our opinion, that the Fed is going to be easing financial conditions anytime soon.
I think they probably try to hold all year, but then next year start to cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Itching to get to the long weekend, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market just about positive on the S&P 500, up by 0.2% after a day of really decent gains off the back of a monster gain on one stock, specifically, Tom. The AI revolution, the frenzy, it's here.
Yeah, we saw it yesterday. We reviewed it in the last hour. We can go through it lightly right now. And the concentration with this NVIDIA success that you see if you take, I think it's the top 6 stocks, NASDAQ 100. I'm framing out, John, 28% of the NASDAQ 100. That's outrageous, 32%. That's just out of control. How about 51%?
It's
nuts. Made up of those stocks, and NVIDIA now number 3, out to Facebook.
Go through the numbers. We're up 27% year to date on the NASDAQ 100 right now. And look at the last 10 days before today. Over those 10 sessions, 2-year yields have climbed about 60 basis points. So 10 consecutive days of yields higher. Over the same period, the NASDAQ's up something like more than 4% on the NASDAQ 100. That relationship between bonds and equities that people talk about all the time, that move in yields has not stopped the enthusiasm around the power of some of those names.
The analysis behind that enthusiasm is what is our comfort factor, or how far out we want to go, our terminal value of the profitability of those companies. We were talking retail this week. They make 3 cents on the dollar. They make 6 cents on the dollar. Whoa, they make 12 cents on the dollar. These people are clocking 30 cents on the dollar. Same equivalency, even higher.
And with some stellar growth as well.
Potentially
and the coming much sooner than people anticipated.
That's why you see 30 multiples or 50 multiples as well.
Let's get to the price action right now in the equity market on the S&P 500. Equity futures shaping up as follows, just about positive by 0.2%. We take back some of the move we've seen in the yield curve. On the 10-year, we're down about 3 basis points. I can tell you on the 2-year, we're down about 4. Your 10-year, 378. We'll keep returning to what's been developing in the foreign exchange market. That leg of the stool, 3-leg stool, US, Europe, China. The China leg of the growth stool, Tom, just challenged over the last couple of weeks based on the information that's been incoming. I'd throw Europe into the mix as well. And it's developed into the story where dollar has started to regain some strength. and euro dollars come back from that 111 type level that we were looking at the end of April, back down towards 107.
Pro tip, we're going to be out at Dan Greenhouse's partying on Saturday evening.
Are we invited?
Yes, I think so.
Okay,
if
very
you're
cool.
in China, and you're going, the Hamptons, they're all partying like crazy. That's when you act. Are we going to see China? Are we going to see China act this Sunday? Because we're all asleep waiting for Happy Tuesday.
Dan won't be asleep. He joins us now. Dan Greenhouse, Chief Strategist at Solus Alternative Asset Management. Dan, good morning to you.
Good morning to you, sir.
This move in tech, phenomenal. Even with this move in yields, what do you make of that?
Yeah, listen, I think there's clearly a development here in AI, and I don't have anything particularly insightful to say that hasn't been said already. This is another evolution, or appears to be another evolution of the tech space. You had obviously the advent of the internet, the shift to desktop, the shift to cloud, and obviously now this is the next iteration in the development. And I think there is a fair level of enthusiasm that's warranted. Obviously, trading at 30, 40, 50 times sales is always a question, but the argument among growth investors always is that the E or the S, the denominator, is going to be wrong. And ultimately, you're going to be proven right over time.
To me, the study this weekend, seriously, we're making jokes about China. Maybe they'll do something Sunday or not. Is the new thing to study is, what does hold mean? If I own these things, I mean, should I buy them? Should I sell them? The character of a hold right now is really opaque. I mean, I don't know what hold means for Apple, hold means for luxury goods, hold means for NVIDIA.
Yeah, listen, I think, again, if you're, we're particularly deep value credit and equity investors. So what we're talking about isn't in particular our wheelhouse, but in a general sense, in the thematic standpoint, for a lot of these names that are developing generational technologies, whether it's NVIDIA or Microsoft with ChatGPT, et cetera, the idea of holding is simply, you're going to go up 30%, you're going to go down 50%, you're going to go up 100%. There's going to be volatility, but you're supposed to ride it out because presumably on the other end of it, you're going to realize the gains, a la Amazon in 2000, Apple in 2005, et cetera, et cetera.
These numbers are rough, folks. Don't quote me on these. Greenhouse had them in his note. His note is just chiseled. It's in English. Right now, big cap, large cap up 30%, large energy up 3%. Is energy deep value?
Yeah, I mean, we think so. You mentioned this before, and before we get off of tech, I just want to point it out.
Oh, I'm sorry. I went to energy. I didn't know the script here. Please tell us about tech right now.
You mentioned before about John was talking about how the stock market's up while Treasury yields are up, and obviously there's plenty to talk about in the Treasury market. Sure. But to be clear, these names, the tech names that we're discussing, are driving the gains. And I looked yesterday. The median stock among the FANG or the MAGMA, whatever acronym we want to use, they're up about 30-35% year to date. The median stock in the remaining 495 is down 2% year to date. There is a tremendous bifurcation in size across cap, whether it's large, mid, or small cap. Larger names are doing better, but particularly in large cap, you have just tremendous outperformance with Tesla and NVIDIA and Meta and the like, and then everybody else is not quite doing as much. And so I think looking at the headline index in general belies some beneath the headline developments even more so right now. But to ramble further on to energy.
Please do.
I think energy presents a lot of value. You've had tremendous developments in the space over the last couple of years that have resulted in even more attractive investment opportunities for several funds willing to step into the space. And what are those? We know many of them. ESG has scared a lot of investors out of the space. The implosion in energy prices over the last couple of years has resulted in a lot of energy-focused managers stepping away, and that's created some value opportunities for the likes of us. And then at the same time, and you see it right now, the names aren't just derivative plays on oil themselves. Oil itself is off, call it 40% from the high. Broad energy stocks are only down about half of that. Some are down even less because they're much more now a capital return and an investment story than it is purely an exploration and production story. And that presents a terrific opportunity for funds such as ours and others to try to exploit some of these dislocations in the market.
Let's unpack some of that then. So the S&P 495, I've heard a lot of people joke about that over the last couple of weeks, and I'm with you. Maybe we should build that, Tom, as an index here at Bloomberg, the S&P 495. And strip out some of those big tech players.
It could be like the Dow Jones Industrial Average.
Yeah. Are we going to market cap weight that?
Yeah.
Or, yeah. Price weight it. Let's give that a miss. Dan, there are odd things happening, though, in this equity market. We were mentioning offline, and I think it's worth having this conversation online. The home builders since last June are up 70%.
Sure.
Let's just walk through these odd dynamics right now. Elsewhere, you've kind of got like manufacturing in recession, services booming in certain places. We have these broad, generalized conversations about the economy. The economy's doing X, but beneath the surface, you've got like 20 different economies doing radically different things.
Yeah, I think that's right. And admittedly, that's largely true quite often. The best example that comes to mind when you mention that is the 2014-2015 period, when the industrial part of the economy was largely in recession, and we were worried about a broader economic recession that never materialized. But it also speaks to the diversification in a $20 trillion economy that it's really hard to drag the entire thing down into a recession. But to your point about the builders, and I think this is largely the result of the activity post-GFC, which is everybody underbuilt. We knew that as it was happening, and you were set up for a moment in time where if there should be a surge in demand for your product, aka houses, you just wouldn't have the inventory there to meet it. And COVID came along and just absolutely blew the supply-demand metrics as we understood them out of the water. And what you have now is a situation where 90-95% of homeowners are locked into, call it sub 3% mortgages. So they're not selling and taking on a new 6.5-7% mortgage unless they have to. And so you're forced to buy a new home, which is more expensive, but also the result of the builders. And so the builders are excited about this, and ultimately it's driving a lot of the developments that we see in the space.
This gets to the heart of the bigger economic debate at the moment, and that's the recession call. Do you think we face that kind of scenario? Back in 2014, it was very much China-led. Going into 2016, it's basically services going to come down to manufacturing. Do we face a different scenario this time, or is it the same again?
No, listen, I think every recession is a new spin on the roulette wheel. And this actually is a good opportune moment for me to push back on something that people talk about all the time, which I despise.
Please do.
Which is the idea that we've been waiting for this recession for 2 years.
Would you want?
This is nonsense. What happened was when the Fed started raising rates, people were saying, we're going to have a recession probably next year, meaning 2023. At least my view was we're probably going to have a recession in the middle of 2023. That doesn't mean I expected a recession between now, early 22 and 23. It just means when the Fed raises rates, they usually break something and you have a recession. The truth is the recession was supposed to happen around now. It appears that it's not going to be the case. And so now you have your first real instance where you're pushing out your recession call from, call it Q2, Q3 to Q4, Q1.
You're hugely identified with my good friend Carl Keatoney and others, Scott Wapner over at the Death Star, which is talking about moving things, moving out, doing trades and that. Are people trading too much to create legit alpha?
Probably, but I mean, listen, we know the holding period for equities has been in decline for decades now.
It's Cramer's fault, but other than that,
I don't think we can blame purely Jim Cramer for it. We all bear some responsibility for that development. But listen, I think the research is crystal clear that long-term holdings of value stocks tend to outperform. And obviously there are periods of time that's not the case. And if you look at NVIDIA yesterday...
Where are we right now? Where are we into the end of this year? Is it going to be a trading? Do you need to be supple here? Or do you load the boat on an energy stock that's out of favor?
Listen, I think, a lot of people don't have our holding period. We have some names in the portfolio that the PM has held for 10 years, for 12 years. A lot of people don't have that. I've owned Home Depot since 2009. I don't think a lot of people do that anymore. But I think, listen, what you're dealing with now is a quote-unquote expensive market when viewed from the headline. Although another thing I'd like to push back on is the second derivative of that argument is you have a huge expansion in tech stocks, which is going to drag up the whole market's PE. And so it's not as simple as just saying the market is expensive, but you have on its headline an expensive stock market up against the Federal Reserve that is not cutting rates anytime soon and is trying to engineer an economic slowdown. And if the last 60 years of data shows anything, it's that the Fed, generally speaking, gets what it wants.
We should do a segment next time with you, just Dan Greenhouse's pushbacks. At 3, 4, 5.
Things with which I have a problem.
Pushback.
Home Depot.
Love that.
Home Depot from 2009 up 23% per year.
It's not bad, is it?
Can we sponsor that segment by anger management?
We should do.
Okay.
We should do. Hey, Dan, this was great. It's good to see you.
Thank you,
Enjoy
guys.
the weekend. Thank you. Dan Greenhouse there of Solus, Alternative Asset Management from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. Republican and White House negotiators are said to be moving closer to an agreement to raise the U.S. debt ceiling. Sources say the emerging agreement would cap federal spending for 2 years. If a deal is reached soon, a vote in the House of Representatives is likely to take place on Tuesday. Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's weighing on profits. Jacobs will become Lazard's executive chairman. And shares of Marvell Technology are surging in pre-market trading after the chipmaker said it expects sales of AI-related products will at least double this year. Adjusted earnings for the first quarter also beat estimates. It's the latest chipmaker with a rosy forecast on AI. NVIDIA's market value jumped past $930 billion on Thursday. And wealth bankers in Asia at UBS and Credit Suisse will get a rare incentive for bringing in new money. They'll get a cut of the cash, equal to 15 cents for each $100 of new client money. That's according to people familiar with the matter. Asia was once a key battleground for the Swiss rivals, but they're now trying to show clients stability after that emergency merger back in March. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep
Green World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make a decision?
Deadline closes
Back
in.
and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
The reason why we're here, we've got more money at any given time coming into our government. But when the Democrats took the majority, they are now spending more than any time in our history, and our debt is higher than any time in our history. So let's just get this right.
It's my understanding that the designees of both President Biden as well as Speaker McCarthy will continue to talk, but it is unfortunate that House Republicans have chosen to get out of town before sundown when we are facing a dangerous default.
House Speaker Kevin McCarthy, House Minority Leader Hakeem Jeffries. The back and forth, the blame game continues in Washington, D.C. Publicly, privately behind the scenes, the contour of a deal might be coming together. We'll talk about the details of that in just a moment. Welcome to the programme. In the equity market, S&P 500 futures are positive by 0.2%. Big gains yesterday on the S&P. big gains on the NASDAQ off the back of that monster move in NVIDIA. The NASDAQ 100 had its best day of gains so far for the month of May. As we move towards the end of the month of May, yields have been on the climb over the last 10 days, that's for sure. Today, a break. Yields are lower by 3 basis points to 378 at the front end where the bulk of the move has been. We're down 3 or 4 basis points on a 2-year to about 450. Worth reflecting on this, though. I feel like we haven't talked about it much. The 2-year versus the 10-year. That curve, Tom, back to negative 70. Something. Negative 70 right now.
Let's go up Priya Misran. You're going to do this right now with someone who made a great call here. This is a vanilla spread, the difference between the 2-year and the 10-year yield. And John, any kind of inversion's a big deal. Oh, it signals recession and all that. And Priya came out and said, hey, we're going to 60 basis points, 0.60% between the 2-year and the 10-year. We said, you're nuts, Priya. Then she recalibrated to 80 or 100 basis points with Ira Jersey. We got there. We pulled back. And this week, we're coming back down again, a greater inversion.
Well, forgive the bond market jargon, but ultimately what happened, what started to develop was that classic bull steepener, which effectively means the front end of the yield curve starts to drop. The 2-year starts to rally, anticipating a rate-cutting cycle. And what we've done over the last couple of weeks is take some of that back, take a lot of it back. We've priced out rate cuts and started to price in rate hikes off the back of Fed speak, which has encouraged that stance. There's been a persistent effort, I think, from Federal Reserve speakers, regardless of whether they think hike or pause, but ultimately no cuts, 1. And 2, it's been validated and supported by the incoming information. Whether you look at the economic data, where you look at the economic data, look to claims yesterday. Claims yesterday adjusted off the back of that Massachusetts story and the fraud, and we've got to take some of that out. And we're coming down. We're not going up. That's been a change.
I agree. And Dominic Constam on earlier, that was sobering, what he says here. It's going to happen quickly. It's going to be in the autumn and into the winter as well. What we know for certain is she's in Washington. Anne-Marie Horton is our Long Island hot dog correspondent here on Memorial Day. She knows famous Charlie's Hot Dogs is a place to be Memorial Day weekend on her Long Island. They're going to be barbecuing. There's going to be hot dogs, hamburgers, for key players in the debt debate, and just as importantly, for those listening to their constituents. Anne-Marie, this long weekend, what are the constituents saying to the politicians of our debt crisis?
Well, I think that's one potential issue that these negotiators will be dealing with, if that you have some of these members, either whether very progressive or very right-wing, that they need to make sure that they're going to get enough votes to pass this negotiation, which we're starting to get more details of this debt limit bill. Can they be emboldened when they come back, and does that change how they vote?
Yeah.
Because remember, Speaker McCarthy has told the House that they will have 72 hours for any legislation to read it. So if we were to get an agreement today, and they have 72 hours, they have their entire Memorial Day weekend, whether having a hot dog or a lobster roll. By the way, we'll talk about John's rudeness about the Hamptons a little bit later. But will they come back emboldened, and would they want to potentially ask for more, whether it's pushing back on the White House, if you're progressive and not liking some of the caves they had to make, or if you're part of McCarthy's caucus and you already voted for a bill and you liked some of those deep spending cuts, is this going to be too easy and you're going to want to see more?
Yeah, I look, Anne-Marie, at the idea of coming back, and I think there's been a media frenzy, no fault of anyone's, to look at 5, 6, 8 people. Greg Valliere this morning makes it really clear this isn't about a debate of 5 or 6 or 10 people. It's 100 on one side and maybe 100 Democrats on the other side. There's a lot of people here to play with to get to an agreement. Am I right on that?
That's exactly right. To actually get the deal through, there needs to be votes on either side of the aisle, which is why, as you look at some of the contours of the details coming through, you can see where there are wins for the left and the right. The issue, though, and Joe and I have been speaking to lawmakers every evening on balance of power, and last night the latest was Representative Seth Moulton. I said, what are you hearing? What's in the agreement? And he says, I don't really know right now. They have been keeping this very much so in a small circle in terms of hammering out the negotiations and really under cloak and daggers before they release this text, and then they're going to have to start whipping the votes. If they get it through the House, a big issue could potentially be the Senate, because one senator has a ton of power
to really gum up the works and make this very long, difficult, and cumbersome. And that could be difficult if we're approaching, obviously, less than a week, the June 1st deadline, where the Treasury Secretary says they can run out of cash as soon as that date. And already what we saw from Senator Mike Lee of Utah yesterday is he says if there's not substantial spending cuts, I'm going to make it difficult to get this passed in the Senate. And that's where you're going to have, like, Leader Mitch McConnell really have to come and make sure he can get the Republicans in line to get this over the finish line. It's going to be difficult, though.
You mentioned a couple of names. Going into the weekend, then, if we manage to get some contours of a deal, an agreement, a framework, whatever it might be, who are the names to watch, Anne-Marie, beyond this weekend?
Well, I think some of the names to watch is the group, the Freedom Caucus, like Chip Roy of Texas on the House side. That group has already sent McCarthy a letter saying, please hold firm on the deep spending cuts. And then in the Senate side, it's really the likes of Senator Mike Lee of Utah, also Senator Ron Paul. These individuals we have seen try to use the filibuster, try to not make it easy for Senator Schumer to get something through very quickly. So even if they're able to come up with a deal, that is really the first part of the hurdle of getting this over the finish line. It's a positive step. Goldman Sachs' Alec Phillips and Jan Hatzius are saying they could see this happening today, which means we could see a vote as early as Tuesday in the House, but it's not smooth sailing.
Okay, the floor is yours. We have the time.
Anne-Marie, this is real simple.
She wants to have a rant about the Hamptons. Give her a chance.
Anne-Marie, educate young Pharaoh here on lobster roll at lunch.
Exactly.
I mean, if you're going to go to lunch and have the lobster roll, first of all, it's going to cost you $60, John.
Right.
To have a lobster roll. Go, Anne-Marie. Lobster roll.
It is quintessential. Also, if you have celiac disease or any other dietary issues, they do a lobster roll on a gluten-free bun. It's a must-stop of the summer. And John clearly has not been, because if he has been, he would not be sitting here and just ragging on the Hamptons.
John has been.
He needs a weekend out there.
Believe me, John has been.
Take him out.
John has done a Memorial Day weekend in the Hamptons, saw the price at the end of it, and decided we won't be doing that again. AMH, thank you. Anne-Marie Hordern, down in Washington, D.C., wishing she was somewhere else, clearly, based on how that conversation went.
It's going to be a remote from the lobster roll. It's a sign, John. It says a lobster roll, and above it says lunch.
I do love a lobster roll.
And nobody calls it the lobster roll. They call it lunch.
I do love a lobster roll. Let's put it that way. I do love that.
They were more consistent years ago. Now everybody's trying to do their own little thing, so you really never know what you're getting when you walk.
Usually I order an extra bun because you get so much lobster here in the roll.
Yeah, I agree with that. But the big thing is it warm or cold? Is the first order condition.
Oh, toasted bun.
Toasted bun, but then cold lobster, or do you do the hot butter thing?
No, I don't mind a cold lobster in that. No,
my answer is if someone hands me one, I say thank you.
And I would say thank you.
Thank you. That's very good.
This weekend, though, all about sport. Monaco, Formula One.
Oh, seriously.
Juventus, AC Milan.
The Colonial.
The golf is on.
Yeah.
Very cool.
Michael Block, last place.
We've got the playoff for the Premier League place for promotion.
And Coventry City. I mean, nothing. I mean, we should have asked Ricardo about Coventry City.
We should have asked. I'm sure he would have had a lot to say from New York. This is Bloomberg.
in big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Equities up, going into the weekend. The opening bell about 2 hours away. Your equity market shaping up as follows. On the S&P 500, positive 0.2%. On the Nasdaq 100, positive another 0.4%. We just add some more weight to this rally. Year to date, the Nasdaq 100 up 27% and some. You can thank a couple of names for that. Meta. You can thank NVIDIA. NVIDIA flying yesterday. Just remarkable stuff. We're talking about $150, $200 billion of market cap in a single session on a single name. In the bond market, this has been happening despite this move, with a 2-year back at 450, 449.
That is the story of the week. All the rest, it's been a crazy
10 days,
week.
60
That's
basis point move.
Story.
10 days, 60 basis point move. Equity market not feeling it. FX market is feeling it. So check out the euro. Very close to breaking 107 in yesterday's session. 107.45 right now. Trying to bounce. We're positive there by 0.2%. That's a stronger euro in the mix, but it's been about a stronger dollar. It's been about basically beating up consensus positions. Coming into the year, one big consensus position was just, I don't like tech, because tech didn't work last year. Well, tech's worked this year. So that was consensus position 1, taken out. Consensus position 2 was to get short the US dollar because Europe and the rest of the world, China's reopening is going to be great. Last month, that has been challenged.
Done.
Rate cut story, that's been challenged. What's left?
Done.
What's left?
I think what's left is this imbalance that Dan Greenhouse was talking about. And every day after NVIDIA yesterday, it is this word doesn't work, but it does work. Historic. It's absolutely historic where we are now. This is not 2001, and on and on and on.
So here's my question now, Tom, and I wonder how you think about this at the moment. Give it some thought. Spent a long time talking about U.S. equity market exceptionalism, because in the United States you had Google, you had Facebook, you had Amazon, you had Netflix, you had others as well, and those names were not in Europe. And that's why we saw this big outperformance at the index level on the S&P 500. And now we're talking about names like NVIDIA, the AI revolution. And when we talk about this, again, we are talking about U.S. companies listed on the U.S. equity market. Where do you stand now on this idea of U.S. exceptionalism, just as people were starting to think about Europe and China all over again?
This is really important. We don't have time for it right now. This will be a theme for us next week, I promise. This is really important. The distinction is profit. These companies are minting money, and even companies less successful are making profit versus the silliness we saw in 2001. There's a massive, massive distinction here of they're profitable. Now, the growth may go away, and the 30 multiple may crash down to 23 multiple, doom and gloom. But the fact is, they're still minting money on a quarter-to-quarter
You're
basis.
right, Tom, because when we talk about PEs, at least we're talking about PE, because there's some earnings there. And if you go back 23 years, that wasn't really the story in many places.
And frankly, other years like the crisis in 1998 would have had a little bit to do with losing money as well. Someone with historical perspective on that. This is really special, folks, on Memorial Day. It's a terrific show. The team did not mail it in. They're not saying Happy Tuesday. Either is James Kemp. He is a student of the markets with decades of experience at Eagle Asset Management down to the south side, and we welcome him this morning. James, I'm looking at the Bloomberg Total Return Index. You and I still call it the Lehman Index. Mike gets upset with me when I do that. But the bottom line is you and I had a bear market in bonds priced down that we never imagined. We've barely come back. And just in the last number of days with this new high yield, we're rolling over again. When did bonds recover to the glory that we knew 3 years ago?
Well, good morning, and thank you for having me this morning. I think it's close. And the reason that I say that is if you go back historically, I've been through 5 tightening cycles. And every time we get a tightening cycle or beginning of a peaking process from the Fed, the subsequent returns to the bond market 1, 3, and 5 are unambiguously good. And I think what's happening now is these short-term yields are attracting a lot of capital. We see it. The flows are extraordinary into the money complex. When folks wake up and realize that they can lock in north of 5% yields for the next decade plus, I think we're going to start to see the flows come back into the bond market. Suspect that we get a peaking in 10-year early summer because of some inflationary base effects, but we're pretty close to a strong buy in the bond market right now.
Are you predicting that we will see an inflation-adjusted return on yield, that we will see a constructive real yield environment like you and I remember in our youth?
Yes, I think we will, because I think inflation is trending down pretty significantly. I think the Fed's making a mistake being dogmatic about 2%. I think they're going to have to relax that. But still, a high-grade corporate credit, we can get 6.25%. Municipals on a taxable equivalent basis approaching those levels. Those are real returns and real yields. And historically, they're starting to compete with equity-like returns over the long term. So it's a good time to own duration.
Let's not bury the lead. Let's sit on it. We get the notes from the team here when we get a guest like James on, and I'm reading the notes right now. Recession likely starts in Q4 2024, James. Not 2023,
John,
2024.
I apologize. That's a Q4 2023, Q1 2024 type
your
phenomenon.
Notes are wrong. James, okay, good, because I was getting all excited about where's this extra 18 months coming from. James, walk us through the actual view.
Well, and so what I think happens is we inverted back in October, November. We typically have a 300-day lag. The other part of the equation is with the banking situation, credit conditions are tightening very rapidly. So you have the monetary side pushing rates up. You have the credit conditions getting tighter. Banks aren't going to lend when they're trying to mark their books and they don't know what deposit flight really looks like. They're getting a grip on it, I think, now. So the tenor of the recession sort of lines up on the calendar as a Q4, Q1 type phenomena. And some of the data we're seeing out of labor is suggestive of that. Look, we had a recession last year. We're going to have an earnings recession. These are not, I think, as Tom was alluding to, and you're talking about AI and the like, recessions aren't bad things. They reorder capital. They reorder the industry. Companies now with cost of capital is higher, got to look to productivity, which is the lifeblood of growth given a struggling demographic. This ultimately gets us to a better place. It's just going to be choppy from here to the end of the year.
Well, James, let's relax a bit and kick back and maybe talk a little bit more loosely. I don't care about this word recession so much. I don't care about a group of individuals getting together at MBR and saying that was it happened. I want to understand from your perspective where you think that weakness is going to emerge. Because at the moment, I can tell you, manufacturing's in one, services is not. I can tell you at the moment, home building certainly not in one based on the stock price performance since the last June, with that particular part of the equity market up something like 70%. AI's not in one, absolutely loving it, massive tailwind, tons of enthusiasm. Where are you seeing the actual concentrated economic weakness?
But you talk about the service sector. If you look at things like open table data, it's starting to roll over. You're seeing some pullback in consumption. As mentioned earlier, real wages, even though nominal wages are higher, real wages are actually negative year over year. Credit borrowings, credit leverage, et cetera, is picking back up. The key to all of this is going to be what cracks in the labor market. And this is what the Fed is dogmatic about. Going back to that 2% rate, the only way you get 2% inflation is with a recession and with the labor market rolling over. And I think that's kind of where they're pushing. The other thing that you mentioned in terms of where the market is sort of getting buoyed a little bit is housing. We always get a bump in housing. We always get sort of a little bounce pre-recession. Let's see if housing follows through on that or if housing rolls over a little bit. We know that we have a lack of capacity. We have a lack of supply all the way back to the great financial crisis in housing. So that is a bright spot. I just don't know how big the legs are there. We'll have to watch that.
James, I look at, and I really want to dovetail this into all your work. And I mean, you're bringing Vanderbilt Engineering here, so you certainly get the dynamics All people want to know is, can they clip a coupon and someday get a total return? How far are we from the world of Bill Gross, of Dan Fuss and other bond giants, where you clip a coupon and you get some gain?
Well, let's remember the 10-year Treasury was 40 basis points 3 years ago. When it sits at 380, that's a massive
Yeah, I agree.
move.
It's unusual. Yeah.
And the S&P now is got a yield of about 170. So the script has been flipped, stocks, bonds, and clipping a coupon now is absolutely in the current offerings. And I think what people have to understand is, these yields, if we do have a recession, if the Fed does at some point have to relax these short-term interest rates, you're going to have a much better return profile and income profile by locking up long-duration assets. It's counterintuitive when a yield curve is upside down and inverted, but it is historically everywhere and every time the right trade for individuals.
What about competition from equities? I mean, I get that the tech place is on fire, but it's just so simplistic to say the yield is now better than the dividend because I got dividend growth as well. When do equities compete again?
Yeah, and that's a great point. In our programs, we also use the equity side pretty aggressively. That includes, companies that are paying above market, but have that growth. And that's the essence of it. You've got to have quality. You've got to have pricing power. You want to compound that dividend over time. You don't want to simply take current yield. So those two asset classes, for the first time, 2022 was tough, obviously, for a lot of reasons, but the correlations were positive. So even if you had a balanced approach, you had a negative total return across the board. You use both of those asset classes in concert to make sure that you're getting the optimal yield. Right now, we're leaning more into the bond side because we think that's first to recover. That's first to produce better than market returns relative to dividend equity. But and remember, Tom, and you know this, dividend equity is lagging, right? If you separate the S&P constituents and you look at payers, non-payers, those handful of stocks that are leading that are not income producing for clients are the market story. So even though the dividend is there and the dividend is growing from a return standpoint, it has lagged bonds year to date.
Hey, James, this was great. Enjoy the long weekend. It's good to catch up. James Camphor of Eagle Asset Management. How many messages are you getting about lobster rolls now?
Oh, it's off the chart.
It's ridiculous.
Do
you think anywhere in New York...
We didn't ask Daniel Ricciardo about lobster
Could we get
rolls.
one for breakfast? Because now I'm craving one.
I have to admit, I have to.
Luke's Lobster opens up at 11 a.m. Eastern time, I think. So you've got a couple of hours to wait for that.
Or down at Chelsea Market, there's one I go to there. That's
what's
spectacular. That? I can't remember the name of it, but it's like Lobster House or whatever. And they've got one side restaurant where you sit and you're responsible. And the other one is you sit on stools if you can find one because it's packed all the time. And what I do there, seriously, folks, this is wonderful. Chelsea Market in New York, this is what it's about. First of all, their business is so huge that everything's fresh. That's the first thing. And in America, John, that's not often the case. And there'll always be one thing I've never seen before, and I will try it. Usually I hate it.
What's that?
But
Give us an example.
It was like something you step on in the Philippines. You go to Palawan and, you're out there and you put your foot on something.
Just be careful. There's a wife at home, your wife, who's not going to be too happy with that comment.
I'll try it to keep the marriage together.
Okay.
And it's usually I go down in flames, but at least I try it as well as your basic Maine lobster.
Mrs. Keane watching right now.
Can we get Gerard Cassidy on? We need an authority on this.
Up in Maine.
Yeah.
Proper lobster. Coming up next, Dan Ives of Wedbush on AI and tech. Your equity market positive, 0.2% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from budget increase for the IRS. And another Republican may be gearing up to enter the 2024 U.S. presidential race. The Wall Street Journal reports North Dakota Governor Doug Burgum is planning an event on June 7th to make a major announcement. Burgum's a wealthy former software entrepreneur who was first elected in 2016. And economists now think China's central bank will cut the reserve requirement ratio for major banks by 25 basis points before the end of the third quarter. That's earlier than they previously anticipated. This comes from Bloomberg's latest survey. They also pared expectations for GDP to 5.5%. And Cathie Wood's flagship ETF closed out its Nvidia stake in January, missing out on the stock's recent powerful rally. The chipmaker, the world's most valuable, has added more than $500 billion in market cap since Wood dumped the shares. Wood holds Nvidia across several of her smaller funds, but investors in the flagship ARK Innovation ETF missed out on Nvidia's blistering rally. And Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's weighing on profits. Jacobs will become Lazard's executive chairman. Global news powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Look at tech, it continues to reinvent itself over and over. The latest generation is going to be AI. And I think as you look at the visibility of earnings, you continue to see a strong earnings coming. And I think that that's important because a lot of people continue to say that tech has gotten expensive. But when you start to factor in how much tech has been able to beat their earnings, I don't think it's as expensive as what people think. And I think that trend is going to continue.
Really nice to hear from Larry Adam to catch up with the Chief Investment Officer at Raymond James. He's constructive, has good reason to be. Year to date, absolutely flying on some of those names. Someone reached out on Twitter, Tom, just that restaurant you were talking about over in Chassis Market.
Yes,
Cullen Pistol.
Surveillance correction, folks. Before David Weston emailed in watching this morning. David Weston said,
what did Weston say?
He said, Tom, it's not called a lobster place. Weston's there like 3 days a week.
Oh, he goes to Cullen Pistol?
Yeah, he goes to Cullen Pistol. And thank you so much on Twitter. I had a brain freeze.
I've never been. It looks pretty nice, to be honest with
you. It's spectacular. I can't say enough about it. Fresh. It's like...
I've got a brunch spot that does lobster and scrambled eggs. I'm not going to share it because at the moment it's quiet and I kind of like it that way.
Did you get it with the smashed peas?
No. Just have it as it is. Just like that. It's perfect. I'm enjoying it right now.
It's really, really good.
Dan Ives with us in the studio of Wedbush, weighing in on Nvidia's surge. He wrote recently the following. In 22 years of covering tech stocks and large cap, we have never capitalized, seen a guidance range of this magnitude on a large cap tech name, and thus speaks to our thesis that the monetization of AI for stalwarts like Microsoft, Alphabet, Amazon, Oracle, Meta, Apple, and Salesforce, Tom, is well underway in this Game of Thrones battle among tech players.
This is the interview of the day. There's no question about it. You know, he's competing with Daniel Ricciardo of Formula One fame, and Bob Dole was on earlier, and a bunch of other worthies. This is what matters, folks, because you're living the tech dream like we are, and Mr. Ives is leading the way with optimism on their profitability, their enduring profitability. He is at Wedbush Securities. In Cupertino yesterday, they saw what you saw. What does the NVIDIA 4.4 standard deviation leap mean for Alphabet? And particularly, what's it mean for Apple?
Look, I mean, this, in my opinion, it's $800 billion of incremental spend now over the next decade for big tech. And when you look specifically at the read-through for Apple, I mean, there's no better read-through, what I believe, and we'll see more at the developer conference, in terms of overall demand. And this AI revolution, it's opening up a total addressable market for these big tech players that wasn't there 6 months ago.
Is it profitable, Ed? That's at the top of the income statement. That's CapEx off cash flow. But will it be profitable?
It is a gold mine in terms of profitability from a margin perspective, because that's right now Nadella and Redmond, I mean, they're popping the champagne because for every dollar that you're going to see of AI spend, that's margin incremental 15%, incremental margin. So I think what's starting to happen with these stocks is that Street's starting to look through the trajectory. You're looking at higher margin business, growth that's really going to be, you could really count in two hands the amount of players that are going to benefit on the first, second derivative. And when you saw it from NVIDIA, it shows this is a gold rush that's real, not hype theme, maybe like metaverse, you know, and crypto and some of the others.
So we're going into the long weekend, and there's going to be a bunch of family members of people who follow this stuff, maybe even buy it, who are going to hear of this company for the first time. It's been performing really well for a long time, but for a lot of other people, they might not be familiar with this name. It's not exactly a household name outside of Wall Street. Can you run people through what they actually do?
Sure.
And what they're leveraging here?
So when you think NVIDIA, in my opinion, I view it as the hearts and lungs, the epicenter of really, from a chip perspective, of AI and what I'll call big data technology. Nothing works without NVIDIA chips. Microsoft, Google, Amazon, it's all feeding off NVIDIA. And that's why I kind of view as the foundation, the best derivative in terms of what you see as a forecast, what's coming down the pike 3, 6, 9 months from now, is what you saw from Jensen with the $4 billion guidance rates. Because that now is going to feed into Microsoft, it's going to feed into big tech. And I think, you know, in my opinion, it's not just about the guidance. This is a historic day that shows the AI revolution. I believe it's probably the biggest transformational tech trend I've seen since covering tech in the late 90s.
That's a lot of hyperbolic language. So let's strip some of that down and talk about valuations. When it comes to momentum in names like this, how relevant are valuation metrics, given the story that you're describing and this big future that you're expecting?
I think when you become laser focused on valuation over the next year, you would have missed basically every transformational tech stock the last 15 years. So in my opinion, to look at that, it's looking at the leaves instead of forest through the trees. But I look at it like you could look at an incremental $5, $10 per share of earnings power when you start to trajectory it out. You know, as Tom and I have talked, you know, on Apple, I mean, I view Apple right now in some of the parts. I could argue that AI adds another $30 to $40 per share to the Apple story.
What's Apple doing with AI? What's that about?
Well, I think we're going to see the developer conference, because ultimately they're going to really, right now, the billions they've been spending on AI, it's going to be another use case that you're going to be able to deploy within their install base, within those 2 billion iPhones.
But what are we talking about? Siri on steroids? What are you describing here?
So from an AI perspective, they're really going to be, from a user perspective, be giving users the ability to, on the services side, from cloud, from music, from TV, to more and more of the devices, cross-pollinating between different devices, that you're going to be able to get different information within the actual Apple user. And I think what Cook's going to talk about is AI could be really another foundation, another monetization of the Cupertino growth story.
You're the Uber Bull. You got a lot of people taking shots at you. And any research report, halfway through, there's 3 paragraphs on total risks. What's the lead total risk paragraph to AI?
Biggest risk is basically what I view as the U.S.-China decoupling, because you could argue that that's a risk from an AI perspective. And two,
is
that
Taiwan a risk because this stuff is actually made off TSMC?
I mean, look, I was just in Taiwan a week and a half ago. I think right now it's bark worse than bite, in my opinion, in terms of as an overall risk. Biggest risk is just companies don't spend. They had to hype the economy. Ultimately, they're going to. But as of right now, what we're seeing is, I think this is right now a green light to own tech, in terms of what we view. And I think this is just, I think the start of it. I think tech's being up another 10, 15% rest of the year.
Apple EBITDA margin, 32 cents on the dollar. What does AI do to that out 5 years?
That basically increases by about 500 bips.
So what is it? Some of the parts, did you say up $20?
Some of the part, you can say Apple, it could add $30 to $40 per share as it all gets monetized into the base.
It's amazing, isn't it? It's easy,
I've never heard this.
Easy to sit here and just be smug. I reflected on this a couple of times in the last few years and once more recently. There's this great exchange, Dan, and I'm sure you've seen it, between an analyst on Wall Street, bullish on the internet, and a journalist from 60 Minutes. And the journalist from 60 Minutes is sitting with this analyst on Wall Street and saying, Amazon's worth more than Sears? Does that make sense? He's so convinced he's right about Amazon just being this bubble and Sears being, what Sears was. And I'm just trying as hard as I can to be open-minded about this moment at the moment, Dan. Any reflections on this period and that one?
I mean, this period reminds me of what I viewed coming out of the Apple launch with Jobs in 2007. Right. And it reminds me of my visits with e-commerce companies in the late 90s in terms of, so I would say there's only two other times that I would compare to this. And I believe that's why Nadella, that's why Cook, that's why Jensen are going after AI.
Your buy recommendations built half the houses in the Hamptons. I mean, anything over 5,000 square feet, they got a brass plaque on it. Thank you, Dan. As well, would you like to weigh in on the lobster roll debate in the Hamptons here? I mean, you've got a little bit of experience at that.
I do. I'm super bullish on the lobster roll in Hamptons, but I continue to believe the best lobster rolls are 617 area code.
So up in Boston, you like it with the hot butter or the cold?
I do. Look, and even though I'm a Long Island guy, I'm more of a 617 when it comes to lobster rolls.
John has no idea what we're talking. I mean, you don't have to go to Maine to get the proper New England roll.
I've had lobster in Boston. I'm very well traveled. Thank you.
But I will say Farrow at Durgan Parks years ago. Could you imagine what the waitress would do to John Farrow at Durgan? Your accent, who are you?
But the guy's a legend. It doesn't matter where the lobster roll.
Thank you, Dan. You tell him. You clear that up. I just got this message from Art Vanderlei on Twitter, and thank you for writing in because a lot of you have given us recommendations.
Oh, are we getting recommendations?
Lobster Landing in Clinton, Connecticut.
Oh, yes.
Lobster Landing.
Yes.
Looks like this little shack by the water. It looks fantastic.
Jonathan emails in Surf Avenue, Coney Island. I'm actually down there a couple times a year. Afterthought forces me to go down. Nathan's, there it is, 11224.
Go for it,
and
Dan.
there's some under the radar lobster roll places in Hampton Bays, not in the core Hamptons. Some places are a little off the grid out there.
You can write a research report on this?
I could, and maybe
expense the whole thing,
and maybe a ChatGPT angle as well.
Very cool. Let's make that happen. Hey, Dan, it's good to see you. Dan Ives of Wedbush. Going into the weekend with some of these names ripping. Mike Wilson, Morgan Stanley, with a different perspective on this equity market. That conversation coming up shortly. Looking forward to that. From New York City this morning. Good morning. Equities higher.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with their head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show show that we care, that they're citizens of the community, they're members of a family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
You're always flying blind in this economy.
If you look at the performance in U.S. equities, I think there's a huge amount of dispersion within that.
I still like the equity markets longer term for people that have a long-term horizon.
You cannot be underweight stocks here.
This is pretty classic late cycle behavior.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bramo off today. It's like a three-island tour for the Memorial Day. Having lobster rolls at all three islands as well. We're having fun today, but as we said on Wednesday, you know what? There's some real news flow going on. On a cautious view on the market, Michael Wilson will join us from Morgan Stanley here in a moment. And John, pushing against Wilson is NVIDIA yesterday. And just moments ago, futures up 11 as well.
Well, it depends how you slice and dice the equity market. Dan Greenhouse of Solus was sitting just over there next to you in the last hour, and he talked about the S&P 495. The S&P 500 doing its thing, the NASDAQ 100 doing its thing. But when you take away the big players, Tom, underneath the surface, there's a bit of a struggle. I think we're going into this long weekend stateside, and there's going to be some conversations around the table with the family about perhaps the fear of missing out as the AI revolution starts to take hold. Michael Hartnett of B of A does a great note weekly on a Friday, and he talks about the zeitgeist of the moment. He said, if you're going to lose your job and be replaced by AI in the next few years, might as well own some AI as a hedge, no? And that's kind of the zeitgeist of the moment, according to Michael.
In my take, there's a little bit of silliness going on here, and I can't identify what's the silly part and what's the genuine part.
Agreed.
But my part is Ives was just sitting here, and he's got like a piñata. The hate mail on Dan Ives is tangible. The fact is he's enjoyed Apple from 100 to 170, and the point here is profitability. I don't hear anybody saying this will be non-profitable.
I want to make it even more simple. The point for me is use case. I want to understand, Tom, when people talk about Apple and AI,
I'm not there.
What's the use case? I'm trying to understand
I don't get it.
Dan did his best at explaining it. I wasn't quite there.
Nope.
I'm doing my best to stay open-minded about it. If it is this big revolution, then I think we need to be. But when we start to make stock selection calls off the back of this story, I want to understand use case.
I would suggest, does it embed revenue growth and does it come down the income statement? But the real question is, does it roll over to the rest of the American economy? increased productivity, and that's the separation in equity markets. We're going to talk to Mike Wilson about in a moment. Mike Wilson is riveted on Zevis and the policy people at Morgan Stanley and Washington. A sleepless weekend for Morgan Stanley policy.
Do you think there's actually going to be a sleepless weekend anywhere down into DC and this debt ceiling debacle?
No. It's
the
not a
contours of a
toxic
deal
brew.
coming together?
It's a ballet the president knows well. The thing here, and this is not about the politics, Democrat and Republican. It's about, we got a president who's been through this, 20 times?
Yeah, plus. He's been around a long time, hasn't he?
Yeah.
Seen it a few
That's
times.
Weird. Data, futures up 11. They've turned here moments ago. I got a VIX 18.73.
I've got the S&P up 0.25% on the S&P 500 futures with a lift. Yields dropping back, down 3 basis points. Around 380 though, 378.67. Just amazing to see the 2-year back up at 450 right now, Tom. 2-year yield down by 3 basis points on the day, but we've done the work the last 10 sessions. Back through 4.5% at the front end of the curve.
Right now, and this is important, you need to reset for the weekend. You need to reset for the second half of 2023, and particularly if you've not participated in the 7 tech stocks. Mike Wilson will brief on the caution that is out there. He is at Morgan Stanley, their U.S. equity strategist, and has been, I'm going to suggest, cautious through thick and thin of this pandemic and forward. Mike, what are you writing this weekend to recalibrate a cautious call?
Yeah, good to see you guys. I mean, our call really hasn't changed. We're very disciplined on price. And as you know, we got tactically bullish last fall at 3,500 because that was a good price. And now we're, of course, back to the high end of the range, and that's not a good price. And that's at the S&P level. That's not really what's been interesting over the last 6 or 7 months. As you know, what's been interesting is what's going on under the surface. I would say in the fourth quarter, that was a very hated rally because it was led by kind of the old economy, financials, industrials, energy, materials. It was all based on, the China reopening story, which was legitimate. And technology stocks obviously disappointed, and they did not trade well in the fourth quarter. So it was a hated rally because that's what people own. Now, of course, the S&P is trading at the same price it was in early December when we got cautious again, and tech is obviously going to the moon. And now this rally is loved because this is what people want to buy. This is what people want to own. It's a lot more interesting and, kind of exciting to own AI and technological revolution than it is to own some old economy stock. It's, why do I want to own this long term? So it's just an interesting development. We would characterize this as the bear market is continuing. Okay, this is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. And we think the overriding driver, of this year's rally has been increased liquidity. Liquidity has improved dramatically, both on a global scale, and the weaker dollar has helped. That's going the wrong way now again. And then, of course, ironically, the banking failures that happened in March led to an injection of liquidity from the FDIC and the Fed. And we think those things have really conspired to drive the market. I mean, nobody talks about the fact that crypto is up 60% this year, okay? And then the next one, of course, is the tech world. So this is what's going on. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level. And the second half is going to be a bit choppier and probably downward in the index.
Mike, let's just talk about the index a little bit more, and great to have you with us as always, particularly going into the long weekend. Mike, you really started the debate this week on this program, and we reflected on your note from over the weekend into Monday when you said the following, that there are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market. There was a short list after that of those signals, and one was extreme narrowness, poor breadth. We presented that to Savita Subramaniam, a peer of yours over at Bank of America, and she said narrow breadth is not a precursor for doom and gloom. Mike, I just wanted to give you the opportunity to respond to that. What is it about narrow breadth that you think signals something at the index level?
Well, I think you could debate this one way or the other, meaning when you make a market low, you typically do have, severely negative breadth. That is a good sign. However, the index is usually down with it. So we think where we are is the index is telling you things are rosy, things are fine, and the breadth is telling you otherwise. And then when we put our fundamental overlay on top of that, which is, we're way out of consensus now on the earnings front, then we can make the conclusion that the internals, right, the breadth is being one of those, but the internals and the leadership is telling you that growth is going to be a problem in the second half of this year. Whether that's an economic recession or not, doesn't. We think it's going to be an earnings recession that's way worse than what people are currently modeling. And look, I want to go back to the beginning of the year. You know, you guys are good readers of our reports. You remember in the beginning of the year, I was somewhat nervous that everyone was in the same camp at that point. We were, our view is very consensus on the fire and ice, you know, the tightening and then the slowdown. And so we were trying to figure out, well, how could everybody be right? That doesn't work. And so what we've done now is we've worked off that oversold condition. And more importantly, now I would say the consensus is actually optimistic on earnings again. And that's just where we completely disagree.
So, Mike, can we just build on the challenge to the index level, retesting the lows of last year, given the muscle of 5 or so names doing just ridiculous things, up 100% plus, Meta, Nvidia, etc. Is that a big enough challenge to the view that we can retest the lows of last year?
Well, not necessarily, not at all. In fact, it kind of sets us up where it's probably inevitable now, because what's happening is you're basically forcing people into these stocks at bad prices now. I mean, you know, the valuations last fall on these stocks in particular was extremely attractive. And if you look at the performance of all of these names, with the exception perhaps of the one this week, which, you know, earnings are going up, the earnings are not driving these stocks. It was 100% multiple expansion, which goes back to our liquidity question. So look, the price is wrong in our view, because the earnings are probably going to be wrong for most of these stocks, not all of them, but most of them. And so from here, we think it is still a stock picking game. And of those 6, 7, 8 stocks, my guess is 2 of them will probably be okay, and the other ones will not, because they are the economy. Okay, they can't avoid the economic slowdown and the top line slowdown that we see in the second half of this year.
Mike, maybe a bit off your remit, but I got to go here. Just percolating in the zeitgeist into June is the once again debate of active versus index usage in the equity market. Give us your update on the value of active versus the value of index investing.
Really interesting confluence right now, because, you know, you could argue both are working at the moment, right? I mean, you know, having the right stocks in your portfolio has been really the only way to make money this year. The problem is that those stocks are such a big part of the index. The passive person can say, look, my passive strategy is working as well. You know, and so we still think active will have a comeback here as we go through the next couple of years. It already is to some degree, but boy, it's been, you know, the market, once again, the market is doing a very good job of kind of fooling us into whatever we want to believe. We think active will be the place to be for the next 2 or 3 years. It's going to be a comeback there.
Mike, dovetail this with Ellen Zentner. Take the recession call of Morgan Stanley and dovetail into your caution on equities.
Yeah, so Ellen and team, I mean, they're not looking for a hard landing. What they are looking for, though, is a very sluggish economy. So it's sort of 0% GDP growth.
Right.
Now, that, you know, that's fine if you still got price. Our view is that 0% GDP growth will lead to bad price. And we're already seeing that in the goods sector. And then we've done some consumer work recently, which is we're starting to see signs that even the high end is starting to pull back on spending intentions on services. So, you know, services is 70% of the economy. It's, you know, goods are 70% of the S&P 500 earnings. So in other words, the economy can stay kind of at zero, but that's not going to be a good outcome for S&P earnings in our view.
Mike, do bears eat lobster?
Well, we can't afford it because we're bearish. You know, I mean, lobster's expensive. Plus, I'm cheap anyway, so you know.
Mike, we'll try and hook you up with one. Thanks for appearing this morning. We appreciate it. Mike Wilson there of Morgan Stanley.
We got to do lobster and hot dogs.
Honestly, the feedback is ridiculous.
Who cares about economics, finance, investment, or that? The price, we forget about this. Cullen Pistol in New York, $35 for lobster roll. Beals, Gerard Cassidy, Beals is in Portland. There is a plaque, the Gerard Cassidy Memorial Stool at Beals. It's MKT is the price.
So what we need is Michael
$42.
O'Leary to come over here and start Ryanair, so we can fly from New York to like Maine for $15.
You know, lunch with Gerard.
It'll be cheaper to fly up to Gerard and get a lobster roll there than get a lobster roll in New York.
Money.
Okay, 8:30 Eastern Time. Don't miss this. Tom Keene sitting down with Megan Green of the Kroll Institute and future member of the Monetary Policy Committee at the Bank of England. That conversation coming up.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. Default worries are intensifying, though, in the U.S. as the Treasury's cash balance drops to its lowest since 2021. Data show it fell below $50 billion on Wednesday as the debt ceiling standoff does continue. The Treasury's bank account has been under downward pressure recently as the government implements measures to avoid breaching that $31 trillion debt cap. And wealth bankers in Asia at UBS and Credit Suisse will get a rare incentive for bringing in new money. They're going to get a cut of the cash equal to 15 cents for each $100 of new client money. That's according to people familiar with the matter. Asia was once a key battleground for the Swiss rivals, but they're now trying to show clients stability after that emergency merger back in March. And shares of Marvell Technology are surging in pre-market trading after the chipmaker said it expects sales of AI-related products will at least double this year. Adjusted earnings for the first quarter also beat estimates. It's the latest chipmaker with a rosy forecast on AI. Remember, NVIDIA's market value jumped past $930 billion on Thursday. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. The debt ceiling deadline closes
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
I don't think we're in that world where equities is the no-brainer play anymore, especially not when you have such interesting yields in fixed income. And I think for investors, that's probably the consideration. There is money definitely on the sidelines, but I think the days of just buying equities blindly because you had easy monetary conditions are behind us.
That was Diana Amoa, the CIO of Long Bias Strategies, the Kirkoswald Capital Partners. Great conversation yesterday. This just in from Mohammed Al-Arian, reminding us, TK, that we have Frontier and Spirit Airlines to take us places, and that we don't need
Mohammed Al-Arian is flying Frontier. When was
Spirit.
the last time Mohammed I can honestly say, for full disclosure, I've never been on Spirit.
I've been
I'm
on
sure
Ryanair
it's a great airline.
EasyJet too. I've never been on Spirit or Frontier.
Why isn't Joe Biden talking to O'Leary? Oh, come on in, you know.
We've got Mohammed on in about 40 minutes.
Oh, we do, do we?
Yeah, we do. We do.
Good.
We as a network, as a company, we have.
Won't get out of bed for
Mohammed.
Me. I know that for certain.
On London time, Tom, over in Cambridge.
It is an important day. There's a lot going on here. Data. We're going to the lobster chat in a minute. We brought in a lobster. She's our chief lobster roll authority, Shonali Bassick, with us. But on a serious story today, which harkens back to leverage in hedge funds, and we're going to talk to her right now about risks and shadows and opaqueness that's out there from 2 years ago, or might I suggest July of 1998 as well. I'm going to go right to the top of your story. How leveraged is the leverage discussion of a bond transaction?
Listen, a lot of these trades are very significantly levered, sometimes 50 to 1 or more. And the reason this was always okay is because it's in the Treasury market. This is the most safe liquid market in the world.
Until it moves.
Until it moves. And now it's moving quite violently, as we know. And so we know that ever since the LDI blowups that we saw earlier in the UK, banks have been asking hedge funds to cool it, essentially. They've been asking for more margin. They've been reducing risk. But listen, a lot of this leverage comes from repo markets, sometimes sponsored repo, which is money market funds. So there are a lot of worries here under the surface in Treasury markets.
Gensler wants he wants clarity here. We got opacity in that. We understand we had a banking crisis because we really didn't know what was going on at SVB. Do we know what's his name, Griffin?
Ken.
You know, he's going to buy like the Miami Marlins and the rest of Florida as well. Yeah. Ken Griffin, do we know what he's doing? Do we know his 50 to 1 leverage on these transactions?
Listen, these are called basis trades. They're fairly simple trades that arbitrage the difference between Treasury futures and spot. Citadel, Millennium, Exodus Point, Capula, Alphadyne. These are some of the biggest players in this space. Our sources say that Citadel is not as levered to the trade as they have traditionally been in the past, or as peak leverage has kind of gone before. But we know, guys, not only has this caused major losses among hedge funds in the past, the reason it's a problem is it's caused the Fed to step in. People forget that in 2020, the Fed has had to step in on this trade. And
are they stepping in 2023? Do we know that within our reporting?
I think that's a lot of the problem here and why there's a worry here. There's a kind of implicit understanding in the market that the Fed does step in. They have to step in. The hiccups in the Treasury market are not of the making of the hedge funds this time. It's of Washington. Yeah. However, it's not clear that the Fed wants to bail out hedge funds again.
Just to be clear, why would the Fed have to step in? Why would that be called a bailout of hedge funds?
Well, it's interesting because in 2020, when the Fed stepped in, there was the pandemic going on. So it was more about the pandemic and less about the hedge funds. What's less explained is 2019, when they had to step into repo markets because of more drastic movements. And again, a lot of these hedge funds were levered towards the trade. This time around, if there were any major issues, you could say, well, we didn't cause the Treasury market volatility and we didn't cause the downgrade.
I want to make this clear. Are there major issues now, or are we reporting that there seem to be shadows from 2 years ago?
No, there are issues now. There are issues. The reason there are issues is not that these trades are blowing up right now or anything like that. It's the issue that what underpins these trades is repo leverage and this idea that if there were any potential downgrade in the Treasury, then all of the collateral underpinning these trades are not worth what they were yesterday. So there are real issues in the market that the debt ceiling does exacerbate to some degree. But again, these are highly levered trades and a lot of the leverage is bilateral. So it's very, very opaque. Guys, changes have been planned or talked about since the Obama administration. It's not really changed much at all. And when you see such violent moves in Treasury markets, that's when banks and regulators start to ask questions.
Is there a danger, though, that we're blaming hedge funds for something that is the responsibility of politicians in Washington and poor policymakers at the Federal Reserve?
It's not blame per se. This is kind of a market structure question. There have been a lot of calls in recent years to make this market more transparent, and it hasn't really gone that way. And so when we're thinking about what happens now and the potential risks, I think, even if you're all clear, we have to remember that this is a market with a history of blowups. This is a market that there have been asks for change. And, by the way, it could be forgotten about if they have a debt ceiling compromise here, and some of these issues.
I get the rating decrease idea, even on a 50-to-1 leverage, and I have the clearest memories of learning how you get from 3-to-1 to 12-to-1 to 22-to-1, whatever it was with LTCM. But to John's key question here is, well, what's the so what here if they're just hedge funds, and if they lose money, why do I care?
For the
if Bobby Axelrod goes under, who cares?
Listen, you're making the hedge fund point, which is, hey, we don't see blow ups.
I'm just trying to get on billions here. Play with me. We'll get on billions.
No, and
help me here. What's the so what here if the hedge funds get hammered on this?
Don't forget that the Fed has had to step in before. That is the problem. If there are moves that are already violent that are then exacerbated because you have a ton of leverage in a market as well, and that creates moves that are more violent in repo markets, which, by the way, matter to markets that are not just hedge funds, that's the worry here, right? Toying with a market that is supposed to be the underpinning of the entire capital market.
I mean, Shonali, as our chief Hamptons correspondent, seriously, she's the one with the most distance here. What's the distinction between a lobster roll in Southampton versus way out on Montauk?
Wow, there were a lot of restaurants recently purchased, weren't there? You're probably paying a lot more for them.
Big season, seriously, big season in the Hamptons for the hedge fund crew?
Yeah, I would say so. I mean, obviously they're trying to get out there, but remember, people expect deal activity to come back after we have this debt ceiling issue resolved and after the Treasury general account build and all these arcane things that we're talking about.
That's the hope.
With the debt ceiling issue.
That's the hope, but
listen, they're staffing
why?
up. Like, if into the summer, staffing levels are going to stay high. People are worried about things like, guys, there's so many risks under this market. That's what this story is telling you. And regulators and bankers are asking about it. So the idea of taking a whole lot of time to chill out this summer is not a popular idea.
I just don't get the Hamptons thing. I don't think I ever will. I just don't get it.
I'd rather watch paint dry. I'd have to be honest with you.
I just don't get
It's
it.
not
your scene.
No, you're out there 3 out of 4 weekends of the month.
It's not Shonali's scene. I just don't get it. I don't get it at all. Fly to Europe,
well, that's a different story, John.
If you've got that kind of money,
yes.
If you've got that kind of money,
that's happening.
Or even if you don't fly to Europe.
Yes.
But what about for mere mortals that can't fly to Europe, once every 4 weeks, once every 5 weeks?
Spirit Airlines.
Well, they've probably not got $100 million houses in the Hamptons either.
You go down to New Jersey, right?
What's wrong with Jersey? You used to go to Jersey Shore.
It's a different thing.
Different vibe?
Yeah,
This is where I'm from.
Goes back to gas.
What's the Jersey Shore Hamptons distinction? That's the question you should ask Shonali. She's a New Jersey girl.
History, what?
I like to say it's pure grit.
That's the difference.
Personality, grit, music.
Okay, keep digging. Music, true.
Music, big difference.
Springsteen.
Big difference. Big difference.
Very cool. Shonali, this was great. Appreciate it.
Shonali, thank you. A very important report.
Offended a couple of people along the way. Why not? Okay.
Important
Mohammed,
story.
coming up 35 minutes away. Looking forward to it. Mohammed Al-Erin of Queen's College, Cambridge. Looking forward to that. And we'll catch up with Seema Shah of Principal Asset Management as well. Krishna Mamani of Lafayette College going into the opening bell. To close out, I've got to say, Tom, you know what? Things got interesting again this week. Globally.
Well, I would like to suggest
Gilts,
team surveillance predicted
inflation in the UK, the moves in the Treasury market, AI,
what am I watching?
Breakdown in the euro. It's interesting.
We're not talking Japan. Euro yen 150.23. I mean, at resistance. Interesting to see what they do with the economics of Japan over to YCC.
I'm going to run if I don't see you, TK. Have a nice weekend.
Yeah, well, lobster roll breakfast, we can do that.
I'll see you soon in about
Red Keeper of the Amex would
time.
love it,
They're going to pay for this.
What about this, $200?
Yeah,
this
about
is Bloomberg.
that. Research.
Good morning.
Research.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg Savannah's good morning, everyone. Lisa Abramowitz, Jonathan Farrow, and Tom Keene. Thank you so much for the response today. We're having fun on a Friday before the celebration of Memorial Day, the remembrances of Memorial Day as well. We hope you have a great weekend. The celebration in the market is simple. Futures up 8, doing better through the early trading. You got to believe smaller trading today. Dow futures up 50 points. I did that for John Farrow. The VIX 18.52. There is 2 Bloomberg screens of economic data through the morning, with Michigan coming up later, a Kansas City statistic. Michael McKee has the unenviable task of literally looking through 20 items and the 4 pages of data behind each of those 20 items. What do you see, Michael McKee, this morning?
Well, I see the durable goods orders out right now, but we don't have the personal income numbers yet because I think everybody is hitting the internet at the same time. There we go.
There they go.
Personal income, 0.4%. That's better than the 0.3 last month, and it matches the estimate. Spending, though, stronger than anticipated, up 0.8% compared with a flat reading in March. PCE deflator, this is the news the Fed is watching, is stronger, 0.4%. That's up from 0.1 last month, and it's stronger than the consensus forecast. Puts us at 4.4% for the headline number over the March number of 4.2%. Core is up 0.4, which is stronger than anticipated.
Yes.
And that puts us at 4.7% from 4.6%. And so if we're just looking at these PCE numbers out of this release, you're seeing a lot of pressure being generated on the Fed to maybe raise rates one more time. We'll check in on what the bets are on WIRP, the Bloomberg function, in just a moment. Durable goods orders up 1.1%. That is compared with a 3.3% increase in the month of March.
Right.
Durables ex-transportation down 0.2. So we probably got some Boeing in there. Capital goods orders, non-defense, ex-aircraft, 1.4%. That compares with a 0.6 drop. So one of the things in the first quarter, Tom, that was a concern was that business spending had dropped off. And when we got the revision to GDP yesterday, we saw business spending raised a little bit, and this looks like it's contributing to maybe a return of business to the world.
Take a breath. Look at the data. This is really tough. This is what McKee does better than anyone in the world, folks. It's like 3 days. It feels like 3 days of economic data on steroids. And what it is the markets were going to react. Moments ago, the 2-year yield to 4.56%. Critically, this is not about the intraday chart. On radio, we're showing the intraday chart. And yes, up it goes to a 4.55. Far more importantly, we're getting up to where we're breaching the high yield that we saw in the 2-year of a number of days ago. The curve inversion is further. We go to negative 75 basis points, a difference in yield between the 2s and the 10s. Critically, The 10-year real yield adjusts higher, 1.56% there. These are all global Wall Street key data points indicating a little angst out there about the stickiness. Michael McKee, from where you sit with 15 major data points in Michigan coming up, is this a sticky inflation sum of data?
Oh, sure. And it is not particularly good news for the Fed. One number to give you beyond where we were, 4.1% is the personal savings rate, drops down from 4.5%. So Americans did dip into their savings to spend what they spent. And of course, as we mentioned, spending was up on the month by 0.8 compared with just 0.1 in March. This is going to be a problem for the Fed. This is their indicator. This is the one that they watch and they base policy on, and it is going the wrong direction. Now, it's not that they didn't think that would happen. They expected some volatility and lumpiness in the numbers, but about half of them or more said in the minutes and have said in speeches since then that they're going to probably need to raise rates more. So then the question becomes, do they do it in June or they do it in July? And this kind of moves up the timetable, one would think, to perhaps June.
And what's important here is the vector. I'm not going to do this because we'll waste time getting to Megan Green, and we don't want to do that. But Mike McKee, really simple here. We peaked on PCE deflator year over year 5.46%, I'll say, in early 2002. And I'm sorry, a vector is in place to disinflation there. But is it tested this morning? Is the vector really under threat of disinflation?
Disinflation, it's not under threat at the moment. I mean, we're looking for that kind of progress, but so far we're not getting enough restraint from the Fed's interest rate increases to get us there. And Tom, I told you I'd look this up. We're now up to an 86% chance of a move by July, a 46% chance of a move in June. Those are both significantly higher than they were before these numbers came out.
Michael McKee, thank you so much. Futures up 3, Dow futures up 21 as well. As you know, over the years, I've made clear the Bank of England simply does it better. Maybe it's because it's a surprisingly new public institution versus the Fed and all the codified history of the Fed. But what they do more than anything is they take in people with different views. I think of Adam Posen now at the Peterson Institute, IIF, I'll get it right, International Economics, Peterson International Economics in Washington. I think of David Blanchflower at Dartmouth. And now they go brilliant in a number of months by bringing in somebody really original in economic analysis and policy discussion, Megan Green of the Kroll Institute and, of course, at Brown University. She will join the Bank of England, and obviously with those constraints, she cannot speak about the Bank of England. She cannot speak about the United Kingdom. We checked with her entourage. She cannot speak about the future of Tottenham Spurs, and she can definitely not speak about the politics between Cambridge and Oxford. Is just too deep and too dangerous to go to this morning. Megan, congratulations on this hugely important appointment. I wanted to talk today about the American economy and the certitude we have of guessing vectors of inflation. You're expert at the history of the study of that. Can we actually game a vector of inflation?
Yeah, look, the inflation data was always going to be bumpy coming down, and that's what we're seeing. But I think what we can gauge is sort of underlying trends and look for signs of persistence of inflation in the U.S. The core capital goods data that just came out surprised on the upside. That's about 70% of fixed investment, so that suggests that demand's pretty strong in the UK economy. And core PCE was stronger than many had hoped. So, I wouldn't read too much into one data point, but it does suggest that the Fed isn't done. So even if the Fed does end up pausing, I don't think it's finished here. We've seen that corporate earnings have been pretty strong. That means that there's a lot of labor hoarding that may well continue, keeping the labor market strong. That, again, keeps demand strong, keeps upward pressure on inflation. So I think that the Fed's got more work ahead of it.
One of the Megan Green realities is plain language. You actually speak in English. Thank you for that. That'll help you with the Bank of England. You speak of this as a weird time in history. Define that phrase.
So it's a weird time in history, just given the successive shocks that we've had on the economy between a pandemic, a war. A lot of the indicators aren't really responding, particularly to tightening of monetary policy, as one might expect. And the labor market here is a great example. The labor market is holding up freakishly well, given how much aggressive tightening there's been in the U.S. And as I just said, that keeps demand really strong. And so the Fed's trying to sort of kill off demand to bring it back in line with supply so we can see price stability. But it's just not transmitting, monetary policy is just not transmitting into the real economy as we expected it might.
Dominic Constant was on earlier with Mizuho, also out of Oxford, and he made very clear this is a partition between demand-driven inflation and supply-side inflation. Obviously, that's a pandemic inflation. Are we still living the pandemic in the wall of data seen in America this morning? Are we still living the pandemic in our funny savings ratios and what that means for income and spending?
I think we are. It's a bit too early to say how long that will actually last, but we're seeing it in consumption patterns. We're seeing it in people's decisions to leave jobs, to move. We're seeing it in the real estate market. So the pandemic is very much still with us. And I think some things will structurally change going forward as a result of the pandemic. We're just not sure exactly what it is. If you look at the labor force participation for different demographics, overall, it's recovered in the U.S. It took a really long time, but there are differences, particularly among older workers. And I think that will be with us for a while. That said, we really struggled with supply constraints, not just in the labor market, but also, of course, with global supply chains during the pandemic and in the immediate aftermath of the pandemic. And if you look at a bunch of gauges for global supply chain tightness, it's actually eased quite a lot. So I think that piece has eased, and yet inflation remains stronger than what we'd hope.
Okay, inflation is stronger than we hope, but there's a belief there of getting back. Now, I don't want to get you in trouble with Bank of England here, but the former vice chair of the Fed, Richard Clarida, and others are debating a 2% idea. Would you suggest the greater theory of our macro policy forward is going to be an adjustment of any given central bank's band or target that they're getting back to?
So we're certainly beginning a debate about that, I think, among the intelligentsia, but I don't think we've made much progress on that. Some are calling for a higher inflation target in the U.S. in particular, somewhere around 3%. The Fed and most other major central banks have defined price stability as a symmetric target around 2%. What the academic literature shows is that actually, until inflation gets above 4%, most people don't really notice it.
Yeah.
So I'm not sure. They don't notice inflation, at least, in terms of, the hit to their actual standards of living. So whether it's 2% or 3%,
right.
That may be more of an academic debate.
You absolutely nailed this. I got 1 minute left, Megan. I'm sorry, but this is research out of VCU that Olivia Blanchard is calling sentient inflation. Are we anywhere near sentient inflation where we're just comfortable with our inflation rate?
So no, I don't think we are near an inflation rate that we as the public or that the Fed's willing to tolerate in the U.S.
Right.
I think it will need to come down closer to the 2%
right.
target before the Fed's really ready to hang up its boots and be done with it. So as I said, we might get a pause in June, but I wouldn't take a pause to mean that the Fed
right.
is done. I think there's more work to be done.
Megan, very quickly here, and I'm really trying to stay away from the Bank of England police here, and I think I'm safe going here as well. One of the great things about Fenway Park, Megan Green, and it's not Narragansett Lager beer, it's the Yankee Lobster Company. Can you give us a rating on the lobster roll from the Yankee Lobster Company at Fenway Park?
I can't, Tom, because why would anyone ever get anything but a Fenway Frank at Fenway Park? So I've never had it. I stick with Fenway Franks.
Bottle that, and you will see that as she enters the August doors of the Bank of England. Megan Green, congratulations from the Kroll Institute. And she's 100% correct about hot dogs and beer at Fenway. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. Republican and White House negotiators are said to be moving closer to an agreement to raise the U.S. debt limit. Sources say the emerging agreement would cap federal spending for 2 years, permit defense spending to rise 3% next year, and offer concessions to both parties on energy. If a deal is reached soon, a vote in the House of Representatives could take place as early as Tuesday. And economists now think China's central bank will cut the reserve requirement ratio for major banks by 25 basis points before the end of the third quarter. That's earlier than they'd previously anticipated. This comes from Bloomberg's latest survey. They also pared expectations for GDP to 5.5%. And Bloomberg has learned that UBS and the Swiss government haven't agreed on the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of that takeover, including capital requirements and liquidity rules. And Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's been weighing on profits. Jacobs will become Lazard's executive chairman. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
You're always flying blind in this economy. There's a lot of choppiness, there's a lot of noise out there. I mean, I kind of, the big picture here, I think, in terms of the economy is it continues to expand. It seems at a, they call it modest pace at this point.
Bloomberg Surveillance, Jay Bryson there from Wells Fargo, really giving a wonderful perspective yesterday. This has been, in all the years I've been doing this, folks, to my team, I can just simply say this has been the strongest Friday before Memorial Day that we've seen. As John Farrell mentioned, it's been an extraordinary week. We saw this Monday, Tuesday, and it doesn't end today. The 2-year yield, 4.58%, is a wow statistic. The inverted yield curve goes from negative 50, 4 cups of coffee ago, to negative 76 basis points. The real yield maybe not getting the press it should, but the 10-year real yield, 1.55%. I want to take 30 seconds here on Peter Orszag. He was definitive at the London School of Economics. This is one of the rarest times where you see within Wall Street a true academic and policy wonk vault to being the chief executive officer of one of our storied names. This is, of course, Lazard Frères. Peter Orszag owns the high ground on research on our terrible medical system. I know it's not as bad as England and that, but as a young Turk, he was absolutely definitive in changing the debate on healthcare in America, and particularly on the processes of our complete garbage retirement system. I can't say enough about that. When you hear me say the phrase glide path, which is basically mathematics and Newtonian calculus. Maybe it's from his father, iconic at Yale. But when you hear the phrase glide path, that's a direct steal from Peter Orszag. This is an inspired announcement by Lazard today. Okay, futures up 4, and we're going to get to the only interview that matters, and we're not going to talk about lobster rolls with Helene Becker. She is senior what in God's name is going on with the airline industry analyst at Cowen and joins us today. Helene, I'm going to talk with a safety issue. The Wall Street Journal had that bars chart yesterday on collisions and near collisions of aircraft. Why are we seeing that?
Yeah, I just think there's a lot going on in the airline industry right now in aviation. Airports are really packed, as you know, and the runways are equally as crowded. Kind of rush, think of cars on the highway at rush hour, sort of same for the planes. I want to say, though, Tom, that the U.S. aviation system is safe, probably one of the safest in the world. And these runway issues, I think, are just temporary as we work through some of the issues that are out there.
How far are we back to the summer of 2019?
We're there. We're past there. What I find amazing is we're forecasting beginning yesterday through Monday, Labor Day. So that kind of a little more than 3 months, 275 million people will travel via air this summer. And that is an increase over where we were 4 years ago, where we were last year, double-digit increase over last year, mid-single digits over 2019. So really strong summer.
What is the constraint moving forward to a better experience? Is it the planes? Is it the pilots? I saw an article that some pilots don't want to be promoted because it's not worth the money, etc. What's the Helene Becker constraint limiting us to a better experience?
Yeah, I mean, look, I think it's just the level of people and the lack of infrastructure. We've been talking about this for years at this point, probably since 2013, actually. In terms of pilots, the most senior pilots are retiring or have retired, and they're being replaced with younger pilots who just have to get up to speed. Not unsafe. I just want to reiterate the fact that pilots who work in the U.S. air system are as safe as can be and are well trained, and that's really important. But we do have a lack of air traffic controllers. Secretary of Transportation said a couple of weeks ago we were short 3,000. And when you think about how long it takes to become an air traffic controller, you realize we're going to be short thousands for years. This is not a problem that's going to be resolved this year or next year. It takes at least 2 years to 5 years to become proficient. And Tom, you mentioned pilots don't want to move from the right to the left seat. Well, controllers don't want to live in New York, Chicago, San Francisco, LA, Miami, where it's really busy and really expensive to live. They don't make enough money to afford to live in these cities.
Let's switch to the securities analysis of the moment as well. I've been thunderstruck how, to pick on United Airlines, Fortress Kirby, that, they collapsed in the pandemic, they bounced off a little bit, and they've really gone nowhere. Are airlines a mother of all opportunities, Helene Becker, to rebound to pre-pandemic pricing?
Prices, yeah, I think they are. I think we're going to have a record summer, as we've talked about. I think, as you point out, the stocks are back to 2020 lows for the most part. And the pushback I get from investors is this is as good as it gets. Pricing's very strong, demand is very strong. And why will this continue, especially if we head into a recession? And the way I think about it is we're back to 2019 levels in terms of passengers, but capacity is down between 10 and 15%. And so you've got more seats per departure. They're up about 15%, 14%, but you have fewer departures per day. And so you've got 90+% load factors, which makes recovery from irregular operations difficult. But in terms of valuations, the airlines are going to make a lot of money, and nobody believes it. Nobody believes this is, or investors for sure don't believe this is sustainable.
One final question. Is our fleet aged? A guy named O'Leary was in here this week. He runs a small airline, and I think it's out of Ireland, called Ryanair. I'm trying to get Ryanair to come over here, Elaine. I've failed so far. And he's talking about the purchase of 300 airlines from Seattle, Chicago, wherever Boeing's going to land here in the next 12 months. And the answer, Helene, is I'm worried about like the age of the fleet. It seems to be okay. Am I right?
Absolutely. So American has one of the youngest fleets. They refleeted between 2014 and 2020. This is a lower year for them for CapEx. United's in the middle of refleeting. They were the ones that didn't actually retire any wide-body aircraft during the pandemic, while the other two big airlines, American and Delta, did. Delta's been refleeting. So yes, we have having gone maybe a decade ago from the oldest fleet in the world to right in there, right in the mix, and on its way to the youngest.
Helene, one final question. The youngest afterthought emails in and says, can you ask Ms. Becker the wonderful cookies that Delta serves? When they come down the aisle with a tray with the cookies and the potato chips and all the stuff she tosses into her bag, do they pay for that stuff, or is that like given to them free because people want the advertising?
No, they pay. That's included in their food budget.
Okay. I learn something every day. Helene Becker, thank you so much. With Cowan as well. Really, really, really interesting time. And I'm sorry, folks, this is something we're going to do, and I really can't say enough about Bloomberg News aviation coverage. It is truly world class. And you see like the graph rather in the Wall Street Journal, and you got to lead with this stuff about, okay, we've come through this terrible pandemic. We're back. And what I'm hearing from Helene Becker there is maybe a lack of experience out there in the different parts of our transportation system. Stay with us through the day on radio and television. We'll give you really nationwide any of the slowdowns that we see. Should point out, for those of you thinking LHR, serious British Airways problems over the last, I believe, 2 days. Once again, BA has technological difficulties that have led to some real disasters at Terminal 5. Not disasters, that's not the right word, slowdowns at Terminal 5 at LH. Our futures up 5, Dow futures up 32. What I can say for Lisa and John, it's real simple. We have a changed yield landscape, 4.59%, up 5 basis points further from the ginormous move yesterday on 2-year yield is the headline statistic. We didn't talk anything today about the oddities of the 3-month T-bill market, given the debt coverage. Look, the balance of power today and our government coverage through the weekend on the debt crisis. It'll be interesting to see. I would assume there'll be no let up on that through the weekend, and that's expressed in our world in the 3-month Treasury bill, 5.31%. Less stated here is crude with a little bit of a bid here over the week, 72.63 on West Texas Intermediate. Will Kennedy saying that's still pretty darn cheap as things go. DXY 104. We're watching Euro, not a 106 print yet, but Euro worked weaker through the week. Coming up on lobster rolls, El Arian of Queens College. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend, a long weekend. Live from New York City this morning. Good morning, good morning. Equities higher, bond yields are too again. We're going to talk about that. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the AI frenzy driving big equity market gains. A debt deal taking shape going into the weekend as investors price out rate cuts and price in hikes. We begin with the big issue, the race to secure a deal and enjoy the long weekend.
Republicans are driving us down a dangerous road of default. Many extreme MAGA Republicans have made the political calculation that a dangerous default and crashing the economy and triggering a recession is in their political interests.
The Democrats today are not the same Democrats. They're very extreme. We see them up their anger right now against the president when he's trying to curb spending at the same time negotiating with me. That's not productive.
So publicly, lawmakers are still busy insulting each other. Privately, the contours of a deal are coming together. According to people familiar with the matter, the two sides have narrowed some of their differences in recent days. Negotiators said to be moving closer to an agreement to raise the debt limit and cap federal spending for 2 years. President Biden remaining optimistic.
Speaker McCarthy and I have had several productive conversations, and our staffs continue to meet as we speak, as a matter of fact, and they're making progress. I've made clear time and again defaulting on our national debt is not an option.
Just for good measure, to focus minds, talk's getting another reality check. The Treasury's cash balance dropping below $50 billion, according to the latest data. That's down from more than 76 the day before and almost a third of what it was in the middle of May. Joining us now to discuss, Anne-Marie down in D.C. alongside Katie Lyons. Morning, Anne-Marie.
Good morning, John. So we are seeing potentially the contours of a deal before we head into this long Memorial Day weekend. And this is important because when Speaker McCarthy took the gavel, became Speaker, he told his members he would always give them 72 hours to read legislation. So potentially, if they're able to come to an agreement today, get the text worked up, we could see a vote as soon as Tuesday, and that's going to be necessary because we are really starting to close this gap ever so narrow towards June 1st. There's one thing we should mention when we're talking about the contours of this deal. Yes, it raised the debt limit. Yes, it capped spending. But at what level does it cap spending? What our reporting from Kayla Gardner and Justin Singh talk about is that actually defense spending would go up, and they do want to make sure that there is going to be enough funding for veteran programs. One win the GOP, Jonathan, may be able to get is that they're going to take $10 billion out of the $80 billion that was supposed to go to the IRS from the president's Inflation Reduction Act. But progressives, one win they're going to get is a measure when it comes to renewable energy. And this has to do with transmission lines, and the GOP will get speeding up of permits. So something in there for everyone. But Speaker McCarthy made it very clear. Not everyone is going to be happy with this deal. And that is why next week, even if there is an agreement today, is going to be very difficult.
And Kelly Lyons, that's what we've got to focus on. What, or rather who, are you focused on right now?
Well, it's the far wings of both parties, right, John? Because in theory, those on the far right side of the Republican Party don't want Speaker McCarthy to be giving up too much. They would like to see deep spending cuts like in the bill that the House already passed. Then on the Democratic side, the progressives don't want to see stricter work requirements for entitlements. And we understand that that is an issue that has not been fully worked out yet. So if you have members of both parties that may not be satisfied with the ultimate compromise, that is what makes the whip count and the actual passage of whatever deal they come to very difficult. And again, we're working against the clock here because remember, June 1st, the earliest potential date Janet Yellen has outlined as the next date is on Thursday. There is not a lot of wiggle room, and even some of the ideas, the alternatives that have been floated to avoid default scenario like prioritization or the 14th Amendment or even something like the $1 trillion coin, Fitch Ratings in the last several days when issuing that ratings watch negative for the U.S.'s AAA credit rating said all of those things would not be consistent with the AAA rating and still could result in a downgrade, even if the Treasury continues to make payments on its debt.
I'll speak for all of us. None of us want to be tracking this going into the weekend. AMH, Kelly Lyons, the two of you, wonderful work through this week. Looking forward to your coverage into next week as well. Joining us now, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, what a privilege to round out this week with you, and what an interesting week it's been. Can I just start in the Treasury market? Yields aren't falling. Treasuries aren't rallying. Yields are rising. Treasuries are selling off. Mohammed, what's going on there?
What's going on is that the marketplace is recognizing what you and I have spoken about, is that inflation is sticky and that the service sector in particular in the U.S. economy is red hot. So we are pricing in more Fed action, and we're also pricing in, ironically, John, that this will end up being a Fed policy mistake. So in addition to the yields moving up, we've got a two-stand inversion now that's at 75 basis points. So you're getting the sense that the Fed is going to have no choice but to hike rates even more, but that will end up risking a recession because the Fed has started so late. And the marketplace has now embraced that possibility.
We were just reflecting on the debt ceiling saga at the moment. Mohammed, how different is this one to the one that you lived and breathed at PIMCO 10 years ago with 5% CPI?
It's different, John, because of the working assumption. At that time, we did not have the working assumption that this will get resolved. Most of us in the marketplace assume that this will get resolved. It doesn't mean there aren't longer-term costs. There are. There are three in particular. One is you erode trust even more in policymakers domestically. Two is you divert politicians away from the work they're supposed to be doing in order to enhance growth, enhance productivity. And third, you signal to the rest of the world that the U.S. economy is less predictable. So, even though we're going to resolve this, and I believe we are going to resolve this, there is longer-term damage being created.
I want to borrow a phrase of yours, risk mitigation characteristics. Do you think this erodes the risk mitigation qualities of treasuries?
It does, John, because it comes on top of many other things. Third countries, what Jared Cohen of Goldman Sachs called geopolitical swing states, they can go either way, are getting worried about reliance on the U.S. debt markets, about reliance on dollars. And unfortunately, the very well-intentioned and necessary sanctions on Russia, I want to stress they were necessary and they're well-intentioned, has pushed Russia into creating a small ecosystem, as cumbersome as it is, that bypasses the dollar. So now countries are thinking, well, maybe it's not as non-feasible as we thought initially. So the last thing we want to be doing in the U.S. is giving people excuses to look for little pipes that go around both the dollar as a reserve currency and our debt markets.
Well, you introduced the US dollar, so let's go there. Do you think the dollar crisis is over now that the dollar started rallying again, Mohammed? Now, I say that tongue-in-cheek, but we have had quite a move from 110.95 on the single currency all the way back down to 107.
Correct, because the interest rate differentials have moved in favor of the US of the last month. John, you know this. We've moved 90 basis points higher on a 2-year in just over 3 weeks. 90 basis points.
It's amazing. I'm looking at the moves right now. We're almost at 460 on a 2-year. So this is the 11th day that yields have been climbing consecutively, 11 days straight. I go back to about 390 on May 11th, so that's something like 60, 70 basis point move just over that period. Mohammed, I was looking at the UK gilt market as well this week. The 2-year there, up 54 basis points this week. Now, Mohammed, I think some people reflecting on the UK and the experience of September, October time, and a gilt crisis, if we can call it that, do you think there are maybe things starting to come together that remind you of what happened in that period?
Well, there's some fundamental differences, as you know, John. Back then, it was a fiscal policy mistake. Today, it's in response to not just headline inflation not falling as fast as people had expected, but core inflation going up. So there's now a recognition that the Bank of England is going to have to hike, and the market has priced in a peak rate of 5.5%. So it's not fiscal driving this, it is anticipated monetary policy. That's issue number one. Issue number two is that this is not viewed as a crisis. This is viewed as a chronic adjustment to higher inflation. And therefore, and this is important, therefore, the longer-term growth effects are going to be more detrimental. Mortgage rates are already moving up. Nationwide announced this morning 45 basis point increase in their mortgage rates. So this is going to make stagflation more likely than not in the UK, unfortunately.
There's the word, stagflation. Just for the UK or for others too, in Europe as well, given the disappointing data we've had out of China?
So, you know, when you go away from the UK, you don't have an 8.7% headline inflation. It's lower in Germany, it's lower in France. Now, we know that the German economy is already in recession. So, yeah, you may get stagflation light. The US is the one that should avoid it unless we get policy mistakes. So the US is the outlier in all this because its domestic economy is much more dynamic, much more resilient, and also much hotter, if you like, than elsewhere.
Mohammed, I just wonder how you'd characterize the inflation growth mix then in the United States, given the data we've had. We've talked about this a few times, both online and offline. You look at manufacturing data worldwide right now, it's screaming downturn, cut rates. You look at services, it's screaming hike. What is the kind of growth inflation mix you're expecting now?
So the inflation one is very straightforward, that because the Fed was late, inflation went from a few items to the goods sector and then got embedded in the service sector. And that has two results. One is it makes inflation less sensitive to interest rate increases. And two, it makes wage inflation more likely. So when you get that migration, and that's why economists hate a central bank falling behind, when you get that migration, you get a dualistic economy because interest rates will hit the goods sector, starting with housing, but will not impact the service sector as much. So that's what you get for a while, and then it depends on what central banks do. And that's why, John, the yield curve is inverting more, because the market strongly believes that the Fed is going to hike once, maybe twice more, and then it's going to have to reverse its hikes later in the year, because this will prove to be too much for the economy as a whole.
Final question then. Where are you for June and beyond on the Fed now?
So, John, what they should be doing, as you know, is they should be recognizing that the monetary framework is not fit for purpose. They should be recognizing that the inflation target of 2% is the wrong inflation target. And they should be implicitly aiming for a higher inflation target until the time comes when they have the credibility to change the inflation target. That's what they should be doing. And if that's the case, they would not hike. But I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike, even though your policy measures have a lag in terms of effects. And this is also a Fed that's so worried about its credibility that it's not going to be wanting to fall behind even more in the perception of people. And it doesn't have the confidence to stand up and say, look, we operate with a lag, and we don't want another policy mistake.
So just to be clear, as things stand, just to wrap it up, I know we've still got CPI still to come before that decision, payrolls as well, but as things stand right now, you think they hike in June?
I do, and the market thinks they hike in June.
Mohammed, we appreciate your time, sir. Thank you. Mohammed Al-Erin, enjoy the long weekend. Thank you, sir. Thank you very much. Looking for a hike in June. Bank of America just published. They say we still expect the Fed to keep policy rates unchanged at its June meeting, but it's a close call, and it's getting closer, which is why you're hearing people like Mohammed say, we might be getting a move just around the corner. Let's get a move on now, going into the opening bell, 17 minutes away. Here's Abby.
Hey, John. Well, let's take a look at one stock that is soaring this morning, and that is the Gap. Shares are up more than 10%. It could be a short squeeze, though. There's a pretty decent short interest on this stock. Actually, it's coming off of those highs, but they put up a surprise profit of a penny versus a loss of 16 cents. And inventories are down, and gross margins are going in the right direction. On the other hand, Ulta Beauty, the opposite story. Their operating margin, they have cut it on theft. The CEO saying it's a concerning challenge. As for Marvell, well, the AI boom continues. They put up a big outlook for 2024 saying that their AI revenue will double.
Abby, thanks for that. Coming up on the program, traders pricing in another rate hike after a busy stretch of Fed speak.
Some of the declines we've seen so far in inflation have been a little slower than I might have anticipated, but we are starting to see some positive movements.
The economic data beating expectations. That conversation up next.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Some of the declines we've seen so far in inflation have been a little slower than I might have anticipated, but we are starting to see some positive movements, and I do think that, again, we can get there without a significant downturn, recognizing that there are a number of risks that we face.
And back and forth we go. Investors pricing out rate cuts, pricing in rate hikes, expecting the Fed to raise rates by another 25 basis points this summer. The change of heart coming with front-end yields moving higher for 11 consecutive sessions, and investors digesting a busy 2 weeks of Fed speak, revealing some of the divergence amongst officials. Citi's Andrew Hollenhorst expecting incoming data to keep, quote, the Fed on track to hike 25 basis points in both June and July to bring a terminal rate around to 550 to 575. Mike McKee, the data, pretty impressive stuff.
Data, pretty impressive stuff. Let's take a quick look at those Fed odds, because you're right, John. After the PCE inflation numbers, investors have totally changed their minds about what's going to happen on June 14th. 58% chance now of an increase on June 14th. And in July 26th, a 100% chance. So we're looking at somewhere between 25 and 50 basis points more going on. Here's the reason for it. Those inflation numbers. The Fed had been making progress, but that progress stalled in April as we saw the PCE numbers for both core and headline rising more than expected, and on a year-over-year basis rising 4.4% and 4.7%. That is not obviously what the Fed wants to see. Interesting chart there you had with all of the Fed speakers that we've had, and we put the sorting hat on one more time, and we can see where they all are lining up at this point. And what is hard to tell is whether anybody's going to switch sides at this point. But right now you've got four voters who are on the team worried, four who are on the team pause. So where are they going to go? And the problem we're going to have, John, is we're not going to hear from Williams, Barr, or Cook now before this next Fed meeting, at least according to the schedule. So we don't know if we're going to pick up one on either side of those votes. But it's definitely going to be interesting going into June 14th to see what happens.
You call that a problem. Some people might be happy with that, Mike, because they get very sick of the Fed speak. And the good news is for those people that there is no Fed speak today going into the long weekend. Mike, always love catching up with you. Mike's going to stick around. We're going to catch up with Mike in about 30 minutes time or so, looking ahead to payrolls next week as well. Joining us now to discuss is Lafayette College, Krishna Mamani and Seema Shah of Principal Asset Management. Seema, I want to come to you. Andrew Hollenhorst says they're going to hike in June. Mohammed El-Erian, literally 10 minutes ago, said they're going to hike in June. What say you?
Well, so we have had a long-term forecast, or well, I guess a forecast for the last year or so, that the Fed would peak at 525 to 550. So in line with that, yes, I think another hike is likely. Whether it's going to be June, July, I think is maybe up for question. You know, I know we've seen a lot of very strong data. We've just seen the core PCE numbers, but we still, you know, there is a lot to play for. There's still the CPI, there's still the non-farm payrolls next week, and I think things could switch. But certainly at this stage, and looking at the strength of the economy, looking at the strength of the stickiness of inflation that we continue to see, I think certainly the market is finally moving in the right direction in taking out rate cuts.
And the impressive data. Now, I said impressive twice there, and I'm using that loosely. Impressive relative to expectations, upside surprises. Krishna, has that impressed you?
Yeah, the economy itself has been quite impressive. You know, Mohammed talked about housing being the most interest rate sensitive sector. And if you look at housing data, there's no sign of any slowdown whatsoever. So I think the economy, you look at claims, you look at inventories, you look at consumption, you look at income growth, there's really not a significant sign of any slowdown whatsoever. You know, it may come down in the future, but it doesn't seem like that today.
I just wonder, Krishna, how divorced this market is right now from rates and this economy as well. When you look at the home builders, I had this conversation with Tom on Bloomberg Surveillance earlier this morning. From last June, the home builders on the S&P are up something like 60–70%, Krishna, even with rates at 7% for a mortgage in America. What do you make of that?
Well, so I think what that is telling you is that because of all sorts of reasons, economic restructuring in terms of people moving out in the suburbs, or stimulus, or come up with anything you want, that housing is probably is not as interest rate sensitive as we have assumed it to be based on our past experience. And I think that is the differential this time around.
Seema, what's your view on that one?
Well, so very, very similar view here from my side. The fixed rate situation in the US just means that there's very, very little interest in selling at the moment and getting a new mortgage at a considerably higher rate. And as a result, there's a lack of stock available for people who are looking to buy. Inevitably, there's always going to be people looking to buy. So then the one that's going to benefit from this is going to be home builders. So it is maybe a little bit surprising in the context of of significant rate hikes, potential for a slowing economy, but then taking a step back and then just thinking about the fact that you've got the fixed versus variable in the US, maybe it does make sense that the housing market is less interest rate sensitive than maybe previously.
Can you say the same thing about the economy? Or would you sit here and say it's all about longer variable lags from here, the cumulative tightening already delivered?
So we do believe that there is going to be recession in the US. We think it's going to be a really short, shallow one. Clearly, what we have seen from the US is, just generally speaking, not just, of course, the housing market, but it is less interest rate sensitive than you've seen in previous cycles. You've got lower debt levels. You have the excess saving part of the equation, which continues to be really, really important. But these things are slowly being exhausted. So we do think that there will be a slowdown. But of course, it is certainly taking its while to play out.
Seema Shah, Krishna Mamani, sticking with us. We're saving the equity market debate for about 7 minutes' time. We've got to talk about this rip-roaring story in big tech and AI specifically. So up next, the morning calls, then later, Wall Street starting to rethink the gloomy outlook. Citi joining a growing list of strategists that are warming up to equities. That conversation just around the corner. Equity futures higher on the S&P 500. The opening bell about 7 minutes away.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Five minutes out from the opening bell, equities up going into the weekend by about 0.2%. A little bit firmer on the Nasdaq, up by 0.3. That's the price action. Let's get to the morning calls. Morgan Stanley naming American Express a top pick, seeing an attractive entry point with potentially 20% upside. Piper initiating coverage on United Health with an overweight rating, expecting the company to deliver sustainable, best-in-class earnings growth over the next decade. That stock is up by 0.3%. And finally, Wolf Research downgrading Snowflake to peer perform, saying the current valuation leaves very little room for error. That stock just a bit softer in early trading. We're down there by 0.3%. Coming up, the rally in big tech, fueling fears of missing out. The bearish calls getting harder to hold. That conversation coming up next. Your opening bell just around the corner.
most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
"25 seconds away from the opening bout to wrap up a really interesting week in this equity market. Equity futures just slightly positive. Some positive follow-through after the monster gains in yesterday's session. On the S&P 500 right now, positive by 0.1%. On the Nasdaq, up by around about 0.3. There's the opening bell. Switch of the board and get to the bond market. Yields look like this, higher by a single basis point. 383 on a 10-year. On a 2-year, the data looking good again relative to expectations. Mike McKee will give you a run-through of that a little bit later in the program. We'll catch up with him again in 15 minutes or so. But we have got on our hands right here 11 consecutive days of high yields at the front end of the curve. The 2-year up another 4, looking at 460. We're talking about 70 basis points worth of weight added onto the front end of the curve in 11 sessions. And with that, some dollar strength. A challenge to the Euro bulls. The Euro breaking down to about 107, trying to bounce. It's a pretty tame bounce. 107.32, positive by not even 0.1%. And crude struggling to get back to 73, 72.83, positive by about 1.4%. Around the open then, 40 seconds into the session, your broader equity market positive by 0.2% on the S&P. On the Nasdaq, up by 0.3. What's stock to watch at the open is the Gap, reporting better than expected results, with cost-cutting measures improving the retailer's profitability. The interim CEO saying, quote, "We continue to take the necessary actions to drive critical change, ultimately getting us back on a path towards delivering consistent long-term results." Abby has more. Hey, Abby.
Hey, John. Well, they did put up a surprise profit. They put up a penny versus the estimated loss of 16 cents. And as you mentioned, it had everything to do with cost cutting along with discounts. Now, relative to the cost cutting, they had a reduced headcount. They also trimmed other expenses. On the discounts, it had to do with freight and other types of discounting their merchandise less. But it's a top line issue. So this stock going into today down more than 30% and 11% short interest. So today's pop up about 10% right now could be a short squeeze. The question is whether or not they can return the Banana Republic and the Athleta to greater growth. Comps at both of those stores declined. Old Navy down just a little bit. The Gap up 1%. So they need to get the merchandise right so that they can also get the top line growth that they need for that long-term turnaround that they're talking about. But perhaps this profit, some of the bottom line coming into view in the way that analysts would like to see, a good start, John.
Nice pop for that name, up almost 12% right now. Abby, thank you. Jeffrey's weighing in on this story and writing the following. "We view these results and the company's reiterated guidance as encouraging. However, we're exercising some level of caution given the uncertain macro environment and ongoing business restructuring." They reiterate their hold rating. That name, though, still up by more than 10% in the first 2 minutes of trading. Sticking with retail earnings, Costco delivering mixed results, topping earnings estimates, but reporting weaker than estimated revenue and comparable sales. Simone Foxman has more. Hey, Simone.
Yeah, John, it took markets a little bit in terms of digesting this. There was a sell-off initially, but then once traders realized there was a pretty large one-time 50-cent per share charge, shares recovered for the most part and now are a little bit higher on the day. But there were signs of weakness in this business, especially in the United States, where Costco gets 74% of its revenue. U.S. comparable sales, excluding fuel and currencies, up 1.8%. The estimate had been for 3.5%. Really, Costco, though, echoing the message we've heard from a lot of big box retailers: smaller ticket size, stronger buying on discretionary stuff, but not so much buying on the bigger margin sorts of things like electronics, home furnishings. A deceleration in sales growth, though, may have been priced in. The company had its weakest sales growth in March in 3 years, and it didn't accelerate that much in April. Maybe that's why we're seeing some positive numbers today. Still, analysts, though, very positive on the stock. There were 27 buy ratings, 14 hold ratings, but 0 sell ratings going into this earnings.
Amazing. In line with the broader market, just about positive, up by 0.3%. Simone, thank you. The broader market up by 0.3%. The Nasdaq up by 0.4%. Let's sit on the Nasdaq and turn to tech. Workday lifting its subscription revenue forecast for the rest of the year, easing anxiety over the appetite for corporate software spending. Katie has more. Hey, Katie.
Hey, John. Yeah, Workday off to the races this morning. Just some context. This is a company that makes software for HR management, among other things. And like you said, it lifted its guidance for that annual subscription revenue. That is a key metric for this company. Those new numbers are $6.55 billion to $6.58 billion. So bumping up the previous lower end of that range. And like you said, going a long way towards reassuring investors that there's still appetite out there among corporations. Remember, we got some results from Snowflake earlier this week that had fanned concerns, but these Workday numbers went a long way towards, again, reassuring investors, not just in the guidance, but also in the previous quarter's results. Fiscal first quarter sales rose 17%, topping estimates. Subscription revenue jumped 20%, and to boot, the company named a new CFO as well. You've seen sell-side analysts just clamoring to raise their price targets. I've seen 3 of them already, and you can see that Workday shares up about 9% at the moment.
Third best performing name on the Nasdaq 100 currently. Katie, thanks for that. Let's get to the number one. It's this one. Marvell recording its biggest intraday jump since 2001, saying it expects revenue from, guess what, AI technology to soar throughout the year. Alex Webb has more. Morning, Alex.
Good morning, John. It's really the tale of what we've been seeing with NVIDIA yesterday, the stellar numbers coming out of there. Marvell is in a slightly different space from NVIDIA, but it does make some chips that have AI applications, and that really seems to be what investors are picking up on. The key thing they're saying is that AI revenue will double in fiscal 2024. When you look at the numbers a little bit more closely, it was $200 million in the previous year, so maybe looking at a doubling to $400 million. That's clearly not nothing, but in the scope of more than $5 billion in annual revenue, it is by no means the lion's share. Nonetheless, we've been seeing growth across some of the other areas. Consumer revenue up, carrier infrastructure revenue up, enterprise networking revenue up, automotive also up. All those things clearly underlying businesses that continue to do pretty well. We do not expect this to be the last time we hear a company bigging up their AI prospects, even if some might say they're not as big as you would think.
I wonder how much, Alex, that is part of the move today, just talking about it. Alex, the move yesterday in NVIDIA, can we finish on that? Alex, what did you make of that move? Just historic.
It's huge numbers. You know, the amount they gained yesterday was more than the entirety of Intel, which was for the longest time the world's biggest chip maker. We're seeing a huge sea change. Talking to analysts today, NVIDIA has placed itself so incredibly cannily, encouraging people to use their entire chipsets if they want to get a piece of the AI business, if they want to get a piece of their AI technology as well. I think the key thing we take away here is what we've learned about what AI is going to be as a business. It is a cloud business right now. It is a way for Google, Microsoft to get people using their clouds. That's why they're investing so heavily in NVIDIA, and that dictates the way that AI is being distributed to the world.
Interesting. Alex, just wonderful coverage, mate, as always. Out of London, Alex Webb there on NVIDIA and other names as well. That helped drive the Nasdaq 100 to its biggest one-day gain for the month of May just yesterday. Some positive follow-through. The Nasdaq up by 0.5%, the S&P up by 0.3%. As tech stocks mount up Are bearish views beginning to mount down? Morgan Stanley's Andrew Sliman now saying stocks could hit 4,600 by year end as FOMO starts kicking in. Quote, if it gets to October and I haven't made money for my clients, then I would start to get nervous. My conjecture is cash starts to get back into the market later into the year. Bank of America's Savita Subramanian boosting her year-end target to 4,300, saying the skeptics are making something out of nothing.
Narrow breadth is not a precursor for doom and gloom. I think it's kind of a false negative. And then when you look at valuations right now, they look high, which is another reason nobody wants to buy stocks. But valuations generally look high when you're in an earnings recession, which we are. If we are in this sticky inflationary environment, do you really want to be in cash or bonds? Don't you want to be in stocks that participate in inflation?
Morgan Stanley's Mike Wilson pushing back.
The bear market is continuing. Okay, this is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level. And the second half is going to be a bit choppier and probably downward in the index.
Back with us on this story, Krish Mamani, Seema Shah. Seema, I wanted to come to you on this and ask you specifically, does narrow breadth matter to you?
Oh my goodness, yes, it really matters. Look, we have, as I said before, we have a view for a recession, and that implicitly should mean that the S&P 500 will go down. And yet, then you have the narrow breadth. So at this point in time, it is so important for investors to not just be looking at the index level, but looking deep under. For us, large cap, mega cap tech stocks, or specifically mega cap growth, I should say, we're always going to do well in this cyclical environment, right? You have a slowdown approaching, you have the Fed at least approaching the end of the cycle, and then of course you have the rest of the global economy looking better. So that implicitly should do well for mega cap tech, and then you add in the AI story, and that's a secular driver. So there's a number of reasons why mega cap tech should be doing well, but it doesn't mean that the rest of the market is going to do well. And certainly if you look under the cover, then actually the other sectors are really struggling. So actually the recession call, the broader market story of weakness does continue to drive through, but that narrow breadth is a number that you're going to see if you look at the screen. You just look at the S&P 500 and you're going to think, wow, things are fantastic.
Well, you can look at the S&P 500, or as some people have joked, many people have joked over the last week, you can look at the S&P 495. Now, Krishna, when you look at those two things right now, I think you could have said the same thing for much of the last 10 years at times. 5 big names driving the stock market higher. What's different this time?
Well, so I think Savita is right. That is, it always seems like breadth is narrow when you are at this point of transition. I think what the question we have to ask ourselves is tech going to go down, or rest of the market is going to catch up to tech, at least some parts of the rest of the market catching up to tech. And I think that really ends up being a call on whether we are going to have a recession or not. And I think on that front, it's quite clear, at least for the, Mike Wilson was talking about the second half. I think second half, from a growth perspective, there's really no challenge whatsoever. If there is any challenge, it'll be that the rate cuts would be priced out. I don't think that is so bad for the 495.
Krishna, your time horizon's different, and time horizon matters. You've got a tactical call, upside risk, and I've been asking this week, is the bigger risk a mount up or a mount down? Do you still think it's that upside risk that's still underappreciated?
Yes, I think the upside risk to the market is much larger than the downside risk. The downside risk was contingent on some signs of a recession, and we don't really see that. Stocks are nominal instruments. When you have this level of nominal growth, expecting that things are going to just crater, I don't think is a realistic thought.
The rally in these names has been so polarizing. As you both know, Meta up more than 100%, Nvidia's more than doubled so far year to date, and it is May 26th. We've got some runway here to get to the end of the year. Seema, I just wonder, do these AI members, these AI winners, speak to another era of US exceptionalism in the equity market? That was where the outperformance was for the last decade. And those names did not exist in Europe. And I feel like this is the early innings of having this conversation again. Is that what this is?
I think you're absolutely right. I think for a little bit of time at the beginning of the year when Europe was doing well, there were maybe some considerations that actually this could be shifting into a more European decade. And we've just seen from technology that, look, Europe just doesn't have the same kind of names. It doesn't have the same kind of strength. So from that perspective, is AI, as long as it's not going to go away, as long as regulation doesn't come in and completely clamp it down, then this is suggesting that the US market is a place to be if you're looking out over a 10-year horizon, absolutely.
Krishna, what do you think the message that is being sent right now from the likes of NVIDIA, Meta, Microsoft to people who are long the Euro Stoxx 50?
Well, the message is pretty simple. I think the European economy is slowing down for sure, and Germany is probably the best example of that. And if bad things happen in China, it gets impacted a lot more. I think the developed market away from the US, at the end of the day, still very much remains a trade, and it comes and goes. I think from a longer term perspective, the likelihood that other markets away from US are going to do materially better, simply driven by valuation, I don't think is a really good thesis.
We've heard that argument a few times, haven't we, Krishna, over the years?
Yes, we have.
Krishna Mamani, Seema Shah, to the two of you, wonderful as always. What an interesting moment for this market. It's such a polarizing story right now. If you're in it, you've been loving it. If you're out of it, you're wondering if you should get in or carry on throwing mud at it. Your equity market right now, 13 minutes into the session, positive by 0.6% on both the S&P and on the Nasdaq too. Coming up, more resilient data ahead of the Fed's June meeting.
I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike.
That conversation coming up.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike, even though your policy measures have a lag in terms of effects. And this is also a Fed that's so worried about its credibility that it's not going to be wanting to fall behind even more in the perception of people. And it doesn't have the confidence to stand up and say, look, we operate with a lag and we don't want another policy mistake.
Mohamed Al-Arian on the programme in the last hour saying they will hike in June. That's his expectation as things stand. As things stand, there's some runway before we get to June 14th. We have payrolls on June 2nd, CPI on June 13th, and you hope that we get a debt ceiling ex-date somewhere in between and a deal before we hit it. That's going to be the story over the next couple of weeks. Mike McKee back with us for more. Morning, Mike.
Good morning, John. Well, the numbers that came in, to quote the late, great Alec Guinness, are not the droids the Fed is looking for. We saw personal income and personal spending both rise in April over March, and inflation rose on a headline and core basis. This is not what the Fed had anticipated, even though they thought we might have some volatility. And here's a really interesting number for you. We saw goods spending rise more than services spending, and we had thought there had been a rotation out of goods. It looks like that is turning around. So that could be a problem down the road if we still start to see goods inflation rise some more. By the way, that PCE core services ex-housing number that is sort of Jay Powell's talisman, that rose on a month-over-month and headline basis during the month of April. So what we're looking for now is the next in the series of numbers you mentioned, John, jobs. Next week, 188,000. Now, that is up from earlier this week. They do see, the economists we survey, a slight rise in unemployment, but not a big change in average hourly earnings. So it looks like status quo. And if Mohammed says that means the data are saying raise rates, the Fed's probably going to want to raise rates.
Mike, amazing, isn't it? That unemployment rate, even with that tick high, is still a full point where the Fed expects it will be by year end.
Yeah, and there's no way we're going to get the kind of jobs numbers they're looking at by year end now. So this June meeting is one in which they give us new economic forecasts. It will be interesting to see what they come up with.
Hyper-focused on those projections, the summary of economic projections, the SCP in that release. Mike, thank you, sir. Just wonderful work. Tremendous, as always, from Mike McKee on the Federal Reserve and on the economy. Here are the job cuts. JP Morgan notifying 1,000 First Republic employees they aren't being given jobs. Bloomberg breaking the news and reporting that 85% of the failed bank's employees were offered full-time or transitional roles. JP Morgan said this: since our acquisition of First Republic on May 1st, we've been transparent with their employees and kept our promise to update them on their employment status within 30 days. We recognise that they have been under stress and uncertainty since March and hope that today will bring clarity and closure. Shanali, the White Knight, sharpens that sword.
The sword is certainly sharpened over there at JP Morgan. Remember, JP Morgan, John, has expanded its headcount over the last couple of years. They've really bucked the trend already when you've seen about the job cuts that have reduced headcount in certain places on Wall Street. JP Morgan just got bigger. Now with First Republic, remember, there will be roles that are duplicated as they bring in First Republic. And even among the jobs that are offered to First Republic employees here, this is about 85% of the 7,000 employees at First Republic. There are many that are offered as transitional roles as well. That is transitional roles between the space of 3 months to a full year. So even in the next year or so, there are going to be questions about how many of these First Republic employees really stay on. This chart is pretty extraordinary, and a really fun fact here. This is the compensation per head count. And at First Republic, you see that it is much more than over at JP Morgan. Remember, JP Morgan is a very large bank with a lot of consumer businesses here as well, so that pay is very dispersed among a wide array of bankers. First Republic was known to bank wealthy individuals and therefore have a lot of kind of private wealth type bankers, but the pay is large relative to the pay per head count you see at JP Morgan. That is what you would expect at a firm like that. JP Morgan is already a story about keeping expenses under control. More on this story ahead, John.
Well, speaking of another story, let's squeeze this in. Some reading for the beach this weekend. Fantastic story written by Shanali and the team. Shanali, the headline: infamous hedge fund trade draws fresh scrutiny during the debt saga. Just give us a tease of what people can expect in that piece.
Yeah, you have to keep an eye on it, John, because if you're JP Morgan, Citigroup, Goldman Sachs, or any prime broker on Wall Street, you are probably getting questions here from regulators because they're worried. The Fed has had to step in before on highly levered trades that hedge funds have made in the Treasury market. The Treasury market has been very volatile. People are worried about overnight financing. People will continue to be worried about overnight financing. Ripple effects are really still unknown, but hedge funds are certainly levered to this market. Crowded trades in there, John.
Very cool. You can find that story on the Bloomberg Terminal and on Bloomberg.com. Shanali, thank you, as always. Let's get you some sector price action. The equity market in this session highs the Nasdaq up by another 0.8%. Here's Abby.
So not surprisingly, John, today with today's gain, a two-day gain for the S&P 500, most sectors are higher, led by tech, up more than 1%. We also have discretionary materials, industrials higher. The only sector lower, utilities. This as yields continue to surge higher. Those dividends look less attractive. Very interesting, though, on the week, the S&P 500 is down about 0.7%, and almost all sectors are lower except for technology. That's true, too, on the year. I was shocked by this. It would actually support the idea that we're going sideways or even down. Internal breadth that you were talking about, not great here. Tech up 32%. Take a look at these other sectors. They are lower, John.
That's some real divergence. Abby, thank you for that. Coming up, your trading diary.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Once again, same old story. The Nasdaq leads. Nasdaq 100 up by 1%. About 26 minutes into the session, the S&P doing okay as well, up by 0.6. That's the price action. Here's the trading diary. Coming up, UMich Sentiment Survey, top of the hour to next week. Markets closed, of course, for Memorial Day on Monday. US consumer confidence numbers out on Tuesday, Thursday. Secretary Yellen's ex-date, plus ISM's manufacturing. And Friday is the US payrolls report. From New York City, that does it for me. Thank you for choosing Bloomberg TV, and please do enjoy the long weekend. I'll catch up with you on Tuesday. This was the countdown to the open. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And